All right. Good morning, everybody, or good afternoon. Happy Saturday. We're here. We are live. We are officially beginning the basics to options class, which is going to entail the very basics of options. And we're going to be going through it probably for the next 2 hours. So hope you guys have some food, some lunch, breakfast, strap in. We're going to get through all this stuff. This is going to be, this is a much requested class that a lot of people have been asking for. And I am happy to be doing it because it is going to help me better explain options. I am not an expert. I'm not a master at this stuff. I am just like everyone else that about a year and a half ago tried to really start deep diving into the concept of options because I was interested. And I think a lot of people that spend time in financial markets and the stock market, you get interested about different strategies that are utilized, which is a good thing. You should be curious and it's something should pique your interest if you see there's an opportunity there. And then it's just a question of how much time and resources do you dedicate to learning about it. So I hope this is one of the resources on people's options journey that can get them to better think and understand of the concept of options, especially for people that really are confused about it and have never heard about it before. And hopefully I can be in a better position to help you guys get through all this stuff. So this is going to be a very simple class. It's going to be interactive with you guys. So it's not just going to be me lecturing. It's going to be me going through a couple slides I have and then asking questions and kind of deep diving into the nuances of what people have to say, because I know this stuff can get confusing. Again, it took me about 2 years to really feel like I can even talk about it or explain it. But once you understand it, it is very powerful. It is very, very powerful. It is also very risky. So there, and we're going to talk about the risks associated with it. But the fact is, if you have a better understanding of what you're doing, there are different ways you can implement these strategies, and it could potentially change your life as well. That is kind of the promise of understanding this stuff going into your own financial journey. So a lot to talk about, a lot to get into. Evan, what's up? Thank you for being here, brother. Trader Status Quo, what's up? Jersey Guido, what's up? Driving to Hoboken. All right, enjoy. I hope you're getting some good lunch at Hoboken. Hoboken's great for food. Zoe Cold, what's up? Good morning. Ray, Dookie Pie. Good morning to you, brother. Thank you for being here. Nishant, Tony, good morning. Spencer, what's up? Noland, Deneen, Giorgio. You are not late. We are literally just getting started right here today. So we are going to get into all of it just right now. All right, cool. Ready? Let's get started. Again, it's going to be really slow, really basic. If you know the basics of options, then this should just be a refresher for those that are literally, like, what the hell is a call? What is a put? That is the point of today's session. We are going to go through the difference between buying options and selling options. That is kind of the big thing I want to talk about here today as well, because I think that's important. I know I do a session with TJ every Friday, and there's probably a bunch of you that don't even know what's happening, but you're just there listening, trying to consume all of that. So this session will be trying to break down all of that stuff in a pretty, hopefully, meaningful way. All right. So before we get started, I want to just start off with sort of two disclaimers. Number one, first disclaimer, not a financial advisor, not financial advice. I know everyone laughs when YouTubers say that stuff, but you got to say it, right? So none of this is financial advice. A lot of this is just information that hopefully can be helpful on your journey of understanding options. Number two, I think that a lot of times people are scared of options and afraid of options because of the taboo that they hear, which is that options will bankrupt you, options will destroy you, options will blow up your account, yada yada. And then they see all these pictures of people that go balls to the wall on some call option, and then they're down $700,000. Then you're like, you know what? At least I'm not that guy, so I'm not gonna even touch options. I think it's fair to have those feelings. However, I think the people that dissuade others from even learning about options are the same types of people that don't want you to progress in life. Because quite frankly, if you're in the stock market and you're trying to assess, can I buy a company? Can I assess how to understand if a company is worth investing in? Is it undervalued, overvalued? Can I learn how to read a balance sheet? Can I learn how to read an income statement? All of this stuff is hard. None of this stuff is easy. And I'm a testament to it, dude. I mean, a lot of you guys knew in 2021, I didn't even know what a market cap was, So it's like, it's been a long journey, and it's been a very rewarding journey, but I did work really hard in this journey. And I quite frankly became obsessed with the stock market to get to this point. And so, and I just love the thrill and the excitement of all this stuff. But in the pursuit of that, I also didn't let people say, oh, never touch options because you're going to bankrupt your account. Like, just stay away from that stuff. I think that's a loser mentality. It's a loser mentality. That's like someone who wants to be a software engineer. Software engineer, coding is hard. And then, you hear someone say, well, don't get into that because that's too hard. It's like, well, life is hard. Everything's hard, right? And there's risks associated with everything that you do. So if you're going to learn about options, learn about financial derivatives, you have to open up your mind. You have to take time to learn. You have to be open to the possibilities of what could go wrong, what could go right. And then you have to take a little bit of a risk. The beautiful thing about the stock market and taking risks is that there are so many resources where you don't actually have to take the risk, but you can assume you're taking the risk. And that is through this website right here, which is the first resource I'm going to share with everybody, a virtual stock exchange on MarketWatch. Some of you guys probably already know this, but you can literally YOLO millions and billions of dollars of options for free because it's not real money on this website. So this is the first resource I want to share with everybody. You can sign up to this right now. If you want to, literally try implementing some of the strategies we saw today, you can just go to a website. Even Robinhood allows you to do paper trading. You can just like add the option to your watch list. And then over time, you can buy a call on, Palantir for $150 2 years out, and you can add it to your watch list on Robinhood. And then you can just see how that contract is performing and how much money you would have made or would have lost if you had invested in that contract. So I think the way to mitigate the fear is have a growth mentality and say, look, I'm in the financial markets. I'm going to try to learn. This one video Amit's doing today is not going to make me an expert, but this video hopefully is a stepping stone to then get into other videos and books and podcasts and learn about this stuff. And then B, when I try it, I'm not going to use my money. I'm going to use fake money and I'm going to see what happens. And then if I want to use my money, I'm going to use $1,000 or $5,000, something I can afford to lose if it goes wrong. And you're not going to let that fear kind of distract you from even having a chance to get into this world. So there we go. That is the small disclaimer. And now let's get into the actual session. So let's get started with options 101. And let's get into what are the point of even getting into options. I will be answering questions periodically through the chat. So if you have questions, put it in the chat and then we'll keep going from there. If you're just joining, we are literally just starting. So you are not late. You did not miss the first half hour. We've been live for 7 minutes. So we are literally starting just right now. Okay, cool. Here we go. Intro to options. So first of all, what are stock options? Let's start with this. Stock options are financial contracts that give the holder the right, but not the obligation. That's very important to understand. The right, but not the obligation to buy or sell a stock at a specific price within a set time frame. They are derivatives, meaning their value is derived from the underlying stock. There are many times where you hear me say derivatives over options. It's the exact same thing. I just think derivatives sounds really cool and makes me sound very intellectual. Makes me sound like I work in private equity or something, even though I don't. But that's essentially what a stock option is. So options are a contract. It is a contract between you and someone else. Someone is buying the contract. Someone is selling the contract. Yes, I'll share this file. After the show, I'll share this file. And the whole point of this contract is that you, the buyer, or you, the seller, negotiating with the other buyer or seller, are trying to come to an agreement on what you think is going to happen to a particular stock. On what you think is going to happen to a particular stock. We might talk a little bit about the Greeks, but again, the Greeks are a little bit more options 202 or 201. So we'll do another session in the future on very, very specific stuff. I want this to be the most basic of basic for everyone, right? So this is kind of just like what are options in the first place. We might talk a little bit about the Greeks, but probably the next session we'll go deeper into Greeks and theta, vega, gamma, all that stuff. So option contracts are you saying, hey, I think a stock might go up. I think a stock might go down, but you're not buying the stock. You're buying a contract that gives you the right, not the obligation to control that stock. Now, another thing to understand about that right versus obligation is that it is always rooted in 100 shares. That's another easy way to understand what is an options contract. You have the right to control 100 shares. You have the right to control 100 shares in that stock option, which again, every time I say option, think of contract. So because we're going to be using contracts a lot, that terminology. So when I say option, think of contract. Also, if you think of contract, from a legal perspective, it gives you a little bit more of just like, okay, so this is the sort of obligation I may have to buy or sell, or the right I may have based on the perception of the obligation to do something based on this stock. I can either buy it or sell it. There's 100 shares in that contract. And if I get into that contract, I am responsible for 100 shares. We'll talk about puts. We'll talk about calls. We'll talk about what that means for those 100 shares. But essentially, a stock option gives you the right to control 100 shares. The right to control 100 shares, either on the direction of the stock going up or on the direction of the stock going down. Options can be a cost-effective way to gain exposure to movements of stocks without owning them outright. This is another really important thing to understand about options. Again, we're still on slide 1. They can be very cost-effective. One of the reasons why hedge funds hedge with options to the tunes of hundreds of billions of dollars is because it is cheaper, theoretically, to buy a call option on a stock versus buy 100 shares of that stock. Going back to that 100 shares, remember, we talked about stock options are financial contracts that give the holder the right to control 100 shares. So if we're always talking about 100 shares, it might be easier in many situations to have puts or calls that represent 100 shares versus actually buying or selling 100 shares. The reason I put Nancy on the thumbnail of this show is because a lot of times she works with in the money options, which we'll talk about later, and she is not paying outright. So for example, she just bought in the money call options on Google. Again, we'll talk about what that means, but at its very basic core, she's not buying Google stock. She's buying a derivative of Google stock, which is the call option, and she is buying the right to control 100 shares of Google stock, not actually own 100 shares of Google stock. Who is the holder, the options buyer or the option seller? Both. So you hold the contract whether you buy it or you sell it, and you can only do one or the other, right? You can't buy or sell the contract at the same time. You can buy or sell other contracts that are similar to the option chain you are in at the same time. That creates spreads, and we'll talk about that. But it is one or the other. You are either buying a contract and holding it, or you are selling a contract and holding it. And when I mean sell, sometimes people get confused. Like when you sell a stock, people think, okay, you bought Palantir, you sold Palantir, right? So you sold Palantir. And option selling, it's a little different. You can buy a contract and then sell that contract in the future for value. But when I mean selling, there's a whole different category of what it means to sell options versus buy options. So whenever I say sell options, don't interpret it as, oh, you bought the Google call option, now you sell the Google call option for profit. Like that theoretically makes sense. But selling options is an entire different category, and it's called selling options for a reason, because you are literally selling those options to buyers from buying options. But yes, you can buy and sell options if you buy it and then sell it for a profit or sell it for a loss. But there's two different categories. One is buy, one is sell when it comes to the actual world of options. Okay, what does it mean when you are writing calls or puts? Exact same thing. So writing is another word for selling, actually. So when someone says, I wrote a call or I wrote a put, they're basically saying they sold a call or sold a put, which again is why there's a different world between buying and selling. It's not just like I bought a stock, I sold a stock. It's selling options, which means you are holding financial obligations within those options, or writing those options. Writing is very similar. It literally means selling. People just use the word writing. But when you're writing a call, writing a put, you're not necessarily buying a call, buying a put, or at least that's not how people use that terminology. Okay, so that's the first slide. I hope no one's confused yet. Stock options are financial contracts that give the holder, which is either the buyer or the seller, you're going to be one of those two people, that is the definition of holder, the right but not the obligation to buy or sell a stock at a specific price within a set time frame. They are derivatives, meaning their value is derived from the underlying stock. Now, that part right there, the second sentence, sell a stock at a specific price within a certain set time frame. Let's talk about that for a second before we get to the next slide. And we'll talk about more about it when we get into calls and puts. But each stock option contract has two things. Two things. A strike price and an expiration. A strike price and an expiration. Now, you probably heard these terms many times. So what is a strike price? What is an expiration? A strike price is the price on the contract that you think the stock that you don't own, you control 100 shares of it via the call or the put, via the option. You think the stock will either go below that strike price or it'll go above that strike price. So, for example, Palantir is at 80 bucks. If I think Palantir can get to $100 in 5 months, I can buy a call option. And that means I am buying the right for owning Palantir at a certain price, aka my strike price at $100 in 5 months by April. So, or I think Palantir is going to $60 by April, right? I think Palantir is going to collapse from 80 to 60, which means I can buy a put. In this case, I can own a financial contract that gives me the right to own 100 shares of Palantir much further below its current price at 80 to a strike price that is 60. That is significantly below the current price. So there's always a stock at a current price. The financial contract that you buy or sell in the derivatives market either can be above that strike price or the strike price can be above that current price, or it can be below that current price. And there is always, always, always an expiration when it comes to that contract. So that expiration could be tomorrow. That expiration could be 2 years from now. Usually the max is about 2.5 years if you buy a very long dated contract. That expiration can be in 5 months. That expiration can be in 3 weeks. So that financial contract has a strike price that is somewhere in the future, usually, even if it's a day into the future. You can't buy options that are in the past. It doesn't work like that. And that strike price is either below or above. Below or above. Cool. We'll get more into that, but that is the very basics of stock options. It is the right to control 100 shares at a certain time, at a certain price, and on a certain underlying stock. Now, why do stock options matter? Why do people engage with stock options? Well, they provide flexibility, which is a very important concept here, flexibility for investors to hedge, speculate, or generate income. Is the strike predefined? Correct. The strike price is predefined. You are allowed to pick your own strike price. There is something called an options chain, and the options chain has tons of strike prices. So for Palantir in particular, I think their strike price goes up to 120, if I'm not wrong. When you enter into an options chain on a stock, which just whatever brokerage you use, you just click trade options, you will see what the options chain looks like. And on Palantir right now, if I go all the way to June 17th, 2027, which is the longest expiration for Palantir, as you can see right here, June 2027. So that is the most amount of time you can put on this contract, about 2.5 years. You can see the highest option price, aka strike, is 120. Now, let's say Palantir goes to 120 tomorrow. This strike would probably go to like 150, 180. A couple months ago, when Palantir was 40 bucks, the highest strike was 60. So as the stock goes up, the options chain, which is created by something called market makers, these are the people that control the buying and the selling of the options at places like Citadel, Jane Street, etc., some of these larger institutions, they will increase the ability for speculators, investors to have more access to engaging with options. So options play a crucial role in modern markets by allowing investors to manage risk and leveraging their positions. If you master options, it can give you an edge by offering a creative strategy for almost any market scenario. Now, what does that mean? Almost any market scenario. Well, markets go up, markets go down, right? And hedge funds, the reason why hedge funds outperformed or underperformed almost all of us last year, I think the best hedge fund made like 30% last year, which is a good year, but like a lot of us, made triple digits, is because hedge funds are hedging. And a lot of times when you are super bullish on a company and you buy a lot of stock, one of the ways to hedge, what is the definition of a hedge? A hedge is protect my downside, right? A hedge is, hey, I have 1 million shares of Palantir, but if Palantir misses on earnings and the stock goes down, I don't want to lose hundreds of thousands of dollars on every single dollar, or millions of dollars at that point if you have 1 million shares. Every dollar the stock goes down, I lose $1 million. I don't want that to happen. So in order to do that, I might use options, financial derivatives, to hedge against that position. Hedge funds are doing that on a scale of literally hundreds of billions of dollars. We, as individual retail investors, could be doing that on a scale of maybe tens of thousands of dollars or maybe hundreds of single dollars. But the point is, it offers you an ability to hedge. And we'll talk about buying puts because that is one of the ways to hedge. But that is really the value of options. And the other way to kind of think of options right here, which is our third slide, is as insurance, as Jimbo Slice says right there, as insurance. Think of options as a form of insurance or a ticket with a deadline to act. Why is there a deadline? Going back to what we talked about 10 minutes ago, there's always an expiration on your option. Always, no matter what. The other difference between stocks and options, and I'm sure a lot of you know this, but this is something that needs to be drilled down. If you buy a stock, if the company doesn't go bankrupt, you can hold the stock forever. Forever. So people that bought SoFi at $20 when it IPO'd and it went all the way down to $4, they were down $16 a share, but they got to hold it forever. Now SoFi's back to 20, and hopefully if they DCA'd, they have a good average, and now they're up on that position. If you bought options on SoFi when it was $20 back in 2021, assuming it would go to $40 by the end of 2023, you lost a lot of money. You lost a lot of money because that deadline to act ended up coming to fruition in terms of, the deadline was reached. SoFi was not at its strike price in that case for that call option, and then you lost your money. So options allow you to control a stock for a fraction of the price. Again, we talked about that example about Nancy not buying 100 shares of Google, but buying the right to control 100 shares of Google. But their value depends on time, volatility, and price movement. We're not going to talk about all those elements. We'll do that in the next session. But the point is, options are a form of insurance. And options are also tools. They're not guarantees. So if you buy SoFi, again, there's no guarantee SoFi is going to go up, but at least you can hold it forever, assuming SoFi doesn't go bankrupt. Options are tools, and because they have an expiration date, if you don't have careful planning that avoids unnecessary risk or mitigates/increases your risk, you could either lose all your money or you can make a lot of money based on how you navigate and utilize that tool. But nonetheless, it still is a tool at the end of the day. Okay, so we're going to stop right there before we go even further. Questions. We talked about what is an option, what is the point of an option. Options allow you to control 100 shares. There is a strike price. There is an expiration. I think those are the 5 main things we talked about. What are questions from there? Suraj, thank you for the $20 super chat. Do you know if you can do a call debit spread like this? Buy a call, let's say for option, Palantir expiring in January 2026, but selling the call for the same expiration at a later date. That is more options 201. So when I answer this question, the people that are confused by it, that's okay, because that's a more deeper question. But that is not necessarily a call debit spread. A call debit spread happens at the same expiration date. What you are doing is called a poor man's covered call. You are buying an option for Palantir in 2026, and then you may be selling a call at a different time to collect premium, which is more so called a poor man's covered call. What you said right there in the last sentence doesn't really make sense, because you said for the same expiration at a later date. If it's the same expiration, then it's not going to be at a later date, right? So if it's the same expiration, January 2026, it's a call debit spread. So you have literally made a spread. If it's a selling call against, that expires in March and your long call is in January, then that's a poor man's covered call. You are using the long call as collateral for the short call to be able to generate premium. So it's not a call debit spread if it's a different date. It is a call debit spread if it's the exact same date, because then the short call is offsetting the premium from the long call, and then you have a call debit spread. How is the premium for options determined? That's a good question. The premium for options are determined primarily by the bid and the ask of kind of similar for how a stock price is determined, right? What is someone willing to pay? Now, it's interesting because a stock like Robinhood has a ton of different dynamics: market cap, price to sales, price to earnings, yada, yada, yada. And then people bid and ask against it. And reasonably, you could say Robinhood's worth $50. Robinhood's worth $45. Robinhood's worth XYZ, because, that gets into the question of how do you value a company? What is their growth rate, et cetera. On the options chain, a lot of it's determined by market makers, the Jane Streets, the Citadels of the world that come up with an existing price. And a lot of it's also determined by the Greeks that we'll talk about in a further session. And a lot of it's determined by the bid and the ask. So whatever someone's willing to pay for an option based on what the market makers priced it at, and they use a lot of different variables to come up with their pricing, is then put against what someone's willing to sell or what someone's willing to buy it for versus what someone's willing to sell it for, just like a stock bid and the ask. And then you get an options price. So that premium ultimately determines how much you're paying or how much you're getting if you're the seller on an option. But usually it's determined through the existing market makers that end up creating that premium in the first place. The Black-Scholes model is another way. Yeah, that gets a little bit more advanced on how we come up with an option price. Can you exercise your call buy contract before the expiration date if it reaches the strike price? Yes, we'll talk more about this in a bit when we get into call options. But yes, you can exercise, and we'll talk more about what it means by exercising as well. Is the premium paid per share? Correct. The premium is paid per share. Again, we'll get into that as well when we get into what is a call option. What is a premium? So a premium is, and this is basically the next slide. So I think we'll might as well get into the next slide because that's pretty much where we're going as well. Okay, cool. So what is a call option? And this will get into the premiums as well. Before that, real quick, let me answer Suraj's super chat and then we'll keep going. Follow up on Palantir example. So if I buy the Palantir call today, but sell the call in 2 months, both for January 2026, we assume price goes up every month. So if you buy a Palantir 2026 call today and you sell the call in 2 months, both for Jan 2026, we assume Palantir price. Yes, so that would still be a call debit spread. That would still be a call debit spread. The price you would pay today for buying and selling the call at the same time for January 2026, that spread would be different than in 2 months. But you can always buy a call and then sell a call later, right? You don't have to literally sell the call at the moment. It's just up to you in terms of, do you think selling the call right now makes sense? Do you think selling the call later makes sense? So for example, Palantir's at 80, you buy the $80 call, then Palantir goes to 100. You can then sell the $120 call and you've just made a $40 spread between 80 and 120 for January 2026. Or you can do that today, given the price is 80, and then the price of the spread will probably appreciate if Palantir gets to 120. So yes, you are allowed to do that at a different time, especially if you assume Palantir's price is going to keep going up every month, because then you can sell the short call and hedge against the long call that you bought on the January 2026 option chain. Okay, cool. So getting back to basics. Now, what are call options? So there are 2 types of options. You guys have probably heard this many, many times. There are calls and there are puts. Calls and there are puts. A call option gives the holder of the option the right to buy the stock at a specific price before a certain date. Investors typically buy calls when they expect the stock price to rise. I will say that again. Investors typically buy calls when they expect the stock to rise. I will say that again. Investors typically buy a call when they think the stock is going up. So whenever you hear calls, whenever you hear buying call options, which I'm sure you guys have heard many, many times, they are expecting the call, investors, to go up. So what did I do on Robinhood last year? A lot of you guys know this. I bought calls. And we don't have to get into the specifics of like what strategy I use, but the point is I bought calls. And because I bought calls and my strike price, which we talked about 10 minutes ago, strike price is the price I thought Robinhood could get to. It's the price I think the stock can get to, or I think the stock can go below, right? In this case, because it's a call and I'm buying the call, which means I think the stock's going to go up, my strike price was higher than the current price. So when Robinhood was $8, I said it can go to $20 or $25, which is really bullish. This is why I had a lot of anxiety last year, because the stock was 8 and I said this sucker is going to go to 25 in a year and a half, which is asking for a lot, right? For a stock to basically 3x in a year is not easy, which is why I'm very grateful to Vlad and company. But like that is a very bullish thing, right? As you can see, Amit's buying a call option at 25, stock's 8. Amit really thinks the stock is going to go up, and I better be right because I've got 18 months or at 15 months, and if I'm not right, I lose all my money, all of it. This is why people say to stay away from options, because it is risky, right? If you have a certain idea of where the stock is going to go and you are wrong about it in the time frame, meaning I don't have Robinhood shares. I can't just hold on to Robinhood forever. If it doesn't get to that level, I'm done. I lose. GG, it's over. All that premium that I paid, going into the question if someone asks, how do you get to premium? I am paying a premium to buy those call options on Robinhood. Now, someone is selling me those call options. We'll talk about that in a little. So the premium is going from me to them. But my belief is that it is better to pay this premium on this call option for Robinhood to get to $25 in a year and a half versus buying Robinhood stock outright. Why? Because the premium I paid was significantly lower than buying the amount of shares I needed to get access to that premium. So for example, if you buy 1,000 contracts of Robinhood call options and you think it's going to go to 20 bucks, you might end up paying, call it $2 a call option, right? So that ends up being $20,000 that you're paying. You're paying $20,000 for those call, or $20, sorry, I should say $20. So let's say you're paying $20 for those call options, right? 1,000 times 20 is 20,000. If you were to buy that many shares at a certain price, let's say if Robinhood's 25, you're paying 25,000, right? So there is a level of, there's a difference in terms of the amount you're paying versus the amount you could be paying. And because of that, you are paying less money, which is good because you're getting access to what is 1,000 shares of Robinhood, or what 1,000 shares times 100 would be what? 1,000 times 100 is 100,000 shares of Robinhood for a fraction of the price. So when Robinhood was $8, if I wanted to buy 100,000 shares of Robinhood, I would need $800,000. I don't have $800,000. But if I want to buy 1,000 contracts of Robinhood and each of the contracts cost me $20, I am paying $20,000. I have $20,000. So the difference there is massive, right? Again, we're still on the concept of call options. Instead of buying 100,000 shares of Robinhood, which is, how do I get to 100,000? Because 1,000 times 100, remember, each options contract is 100 shares. Each options contract is 100 shares. If I want to buy one contract, I can pay $20 if the contract cost me $20, and I get access to 100 shares of HOOD. I have the right to control 100 shares of HOOD. If I want to buy 100 shares of HOOD at $8, I have to pay $800. 800 versus 20, you can see why people get excited to get into the option, because instead of buying 800 share or $800 worth of shares outright, I can pay a fraction of that, $20, to control those 100 shares. So an option is buying a stock on a discount, but for a limited amount of time, 1,000%. You are buying a stock at a discount for a limited amount of time, and you have a certain obligation, strike price and expiration, on what needs to happen in that limited amount of time for the stock to work. So again, going back to Robinhood, I thought it would go to 25 when it was $8. Robinhood ended up going to 40 by the end of December. That option contract went up more than 600% for me, right? So I made a lot of money because I was very correct about the direction of the stock, and I was correct to a degree that I didn't even expect I would be correct for. I was hoping for 25. Robinhood got to 40. You could definitely call it lucky. There was luck involved there. But that's where I made some astronomical returns. Now, that doesn't happen often, and you have to be humble enough to realize that's not going to happen often. The other side of what ends up playing out when it comes to a lot of these options is that you end up being dead wrong. And when you end up being dead wrong on these situations, and let's say Robinhood didn't go to 25, let's say Robinhood, barely got to 15 because they just didn't execute, yada, yada, then you can end up losing a lot of money. And that's when it really, really sucks. So this is what I want to show right here to give a context of people that lose money, which is the example I think I showed on Friday of the guy who went all in on DJT calls. So this guy bought $500,000 of, $1 million of DJT calls, meaning he was assuming that Donald Trump's stock, he bought it on 12/5/2024, so December 5th, and he assumed by March 21st, remember there's an expiration date, right? We talked about there's always an expiration date. He assumed off of his 1,654 contracts, which is how many shares? 1,654 times 100, 165,400 shares. He has the right to control. He doesn't own those shares, but he has the right to control those shares based on the amount of contracts he bought, because you multiply 100 times the number of contracts. He thought it would get to $47. DJT is currently at 36. He is down $429,000. That is where options go wrong. You picked a company that's, trading really on sentiment of Trump and stuff, and no one really knows what DJT trades off of. B, he oversized the position so heavily. I mean, if DJT went to 70, this guy would be making a couple $1 million and he would be laughing all the way to the bank. Unfortunately, that didn't happen. And that could have been me last year. What if Robinhood barely got to 15? I would have been the guy looking like an idiot because I bet big on this stock going up and I was wrong, right? And then you lose all the premium you pay. Going back to the concept of premium, that dude paid $1 million or 1.3 million to a market maker or to someone like you who's selling him that option, because anyone can theoretically become the market maker. And we'll talk more about selling options. And you collected that 1.3 million in premium. He's hoping that 1.3 million in premium turns into 10 million. It ended up turning into 500,000 because he lost $500,000. It was his grandfather's inheritance as well. Yes. So that was not the best thing. So that is the basics of call options. Again, super, super, super basic. It is the right to buy a stock, 100 shares of that stock. Again, I will say it again. You have the right to buy 100 shares, not 200, not 300, not 99, 100 shares. The reason I'm harping on this is because when you think of call options in the future, you have to think in terms of hundreds. So every time you multiply by the premium, multiply by the number of contracts, it'll always ring to you that if I'm buying 10 contracts, I'm actually controlling 1,000 shares. If I'm buying 1,000 contracts, I am controlling 100,000 shares. If I'm buying 100 contracts, I am controlling 10,000 shares. When you think of options as your ability to control that many shares, it kind of changes your perspective on why you're buying the call option versus buying the stock. Because again, if you buy 10,000 shares of a stock, it is significantly more expensive than buying 100 contracts, which gives you the right to then own those 10,000 shares in the future. Now, another thing that's important about call options, and I'll just write this down right here because I didn't write it down actually. But this goes back to the question someone was asking just a couple minutes ago, which is, what do you do with the call option? Well, you have two options with the call options, two things you can do. Exercise the call option or sell the option back to the market for a profit. Exercise means you, let's say you engage in the right to, or you literally, let's use the word exercise because it makes more sense. You exercise the right to buy the 100 shares that you already have the right to own. We'll talk more about that. And then sell the option back. You simply take profits on the new price of the contract. So there's two things you can do with call options, exercise or sell it. Now, exercise means that if Robinhood, let's use just Robinhood example, right? I had the Robinhood call option for 25, but I bought it when it was $8. Or let me rephrase that. Robinhood was $40 by the end of the year, and I had a contract that had a strike price of 25. What I could do, which is I think I did it on one of the market opens, and then you saw Chris call in and we had that conversation about it. I said, okay, I actually like Robinhood. I like Vlad. Vlad's a rock star. I want to own this stock for a very long time. So I was correct. I bought the stock option when it was $8 with my goal being for it to get to 25. Robinhood's at 40. I have a decision to make. Do I want to just sell that contract back to the market? Because the difference between 25 and 40 is 16. So I was up $1,600 on the contract, right? Or $1,500. And I can pocket the $1,500. With my initial $2,500, I have $4,000. I can go do whatever the hell I want to do with that $4,000 and I call it a day. Or do I say, you know what? I actually want to own these 100 shares at $25 because I think Robinhood's one day going to be $100 and I'd rather make $75 on my shares, 100 minus 25, versus $15 in profit. And I'll just buy these 100 shares and wait. I can wait and I'll wait for Robinhood to eventually keep executing and hopefully go up in value. And that's what I did. I didn't do that on all the contracts, but on some of the contracts, I exercised my right, my obligation to buy those 100 shares at $25. Robinhood was 40. So instantaneously, I paid $2,500 to exercise, which means to buy those shares at 25. Now the stock's at 40. So you might be wondering, wait a second, how do you buy it at 25? Well, the guy who sold me the call has an obligation to give me my damn shares. Because we talked about this 20 minutes ago. When you buy an option, someone sells you an option. That someone could be Citadel. That someone could be Matt Money, who's selling Rocket Lab calls. And we'll talk more about what he's doing with selling calls because I think his example makes a lot of sense. That person could be me, who sold some hood options the other day. And I posted about it on Twitter. We'll talk about that. It could be anyone. But the point is you have a counterparty. And that counterparty a year ago said, Amit, we will sell you a call option for Robinhood because we don't think it's going to 25. I think it was going to 25. Now it's at 40. And I'm like, hey, I want my shares, which means they had the obligations to get me my 100 shares. They had to do whatever they had to do it, but I didn't really care. Contractually, they were obligated. There's no way you get out of it. It's not possible. If you have a contractual obligation, you have to fulfill that contractual obligation. And so when I exercised my contract, I got those 100 shares at 25. Now Robinhood's at 50. So theoretically, I've actually made more money than just selling the contract, because as the stock has gone up and now I own the shares because I have a right to own those shares, because a year ago I bought the right to own those shares via the call option. Now the stock's at 50. 50 minus 25 is 25. I'm up $25 on all the shares. It was TJ. Yes, it was TJ as well. It is always 100 shares. It is always 100 shares. Correct. Always 100 shares. We will talk about Steve's Palantir covered calls. Well, we actually will talk about it. Again, I don't want to go super. We're not going to talk about the Greeks. Not today. We're not talking about the Greeks. There's going to be too much for the basics. But we will talk about covered calls and selling puts, because I think that's a very, very important element for understanding options. How can you forecast what the option premium would be if you have a certain price target in mind? I'm talking about calls. Well, it gets into a lot of variables on how the price moves. That gets into deltas and gammas. And then, so that's a little bit more advanced. But essentially, this is credit to Robinhood. They do a very good job showing you a simulation of your returns. So you can literally see how a stock price would go up or go down based on the time that passes, which is like theta for a stock, and how the price goes up in relation to the time. Again, we'll talk about that in a future session, but the option premium, it is predictable. It is very predictable. You can tell if I buy this quite literally, you need to be able to predict the option premium if you're buying an option contract, because you're assuming what the price will be 10 months from now if the stock were to 10x, if the stock were to 3x, if the stock were to stay flat, if the stock were to go up by 40%. So a lot of it's predictable. There's a lot of tools online that make it very easy to kind of just see what an approximation of what it would look like is. But it depends on some other variables that are important to take a look at. So you got the premium up to 25 plus shares. Correct. So I paid a premium for that contract, and then I paid the $2,500 for the 100 shares times 25. All of that together is my cost basis versus the price of the stock. The difference between the price of the underlying stock versus everything I paid for the contracts, for the shares plus the premium on the contract, is the profit that I'm making on the stock itself. Wait, so the other person would have to buy all the shares and give them to you? Correct. So the person who sold me those shares, this is when we get into the concept of a covered call, right? And we'll talk more about it. But if they don't have my 100 shares of HOOD at 25, they got to go find a way to get it. And that's their problem. That's not my problem, right? Just like Trump said, Sam and Elon and Sam have their own beef. That's not my problem. I don't care where you get my 100 shares from. All I know is that I'm obligated to buy these 100 shares. And when I press exercise on my brokerage, on your Robinhood, your Schwab, Fidelity, that's when the brokerage is going to go find somebody that has those 100 shares, and they're going to take those 100 shares. Case in point, I remember when I was in New York, ironically, I was there for Robinhood's Investor Day, and one of the call options that I had sold was exercised. Meaning I was the dude that was responsible for giving someone the 100 shares, and it was like 3 a.m. at night, and I think someone from Hong Kong like exercised their HOOD call option, and then Robinhood sent me notifications like, hey, we just took 100 shares from your account because you were obligated because you sold this contract for someone who wanted to exercise it. And I was like, why? Like, there's a lot of math into when and why you exercise, and we'll talk about that in a future session. But I was just confused. Like at 3 a.m., this random dude from Hong Kong took my shares. I wanted to fight. Like I wanted to square up. I wanted to legit fight. But then I realized, like, I kind of have to. It's my obligation. Like, I can't really fight if I'm like just fulfilling my obligation. I have to give him the shares. But nonetheless, that is how it ends up playing out when it comes to exercising. Cool. We are not talking about rolling options today. That's a little bit more advanced. We'll talk about that. I mean, we'll talk about it as like a theory, but not like the actual specifics of rolling. That'll be in the next session. So if you exercise the option, the only value you get out of the contract is the smaller upfront cost to own the shares. Correct. So if you so for example, I followed Nancy Pelosi. She bought $150 call options on Google. What does that mean? Based on everything we talked about, she believes Google will be at least $150 by January 2026. Google's already at 200 right now. So what she did, and we'll talk about this further later, but she bought in the money call options. So I said you can buy a call option if you think the price is going to get to your strike price. Her strike price, 150, has already been achieved because Google's at 200. So you might be asking, why is she doing this? It's just a safer way to get exposure to Google versus having to buy 100 shares at $200 because then that costs you $20,000 versus buying 100 shares theoretically at 150 that costs you $15,000. Now, Nancy had to pay a premium on that as well. So technically the premium I paid was $60 for the contract, which means 150 plus 60 is 210. So actually Google needs to be at 210 by January 2026. But if Google's at 200 and you're bullish on Google, you think Google should be able to get to 210. That's where the contract becomes profitable. We'll talk more about that later, but essentially you have to pay a premium for the contract you're buying. And here's another thing that's important. I see some questions about this. The premium is lower. Let me say that again. The premium is lower on the call option the further out of the money your strike price is. Example, when I bought Robinhood call options for $25 and Robinhood was $8, they were dirt cheap. Why were they dirt cheap? Because the market makers, the people that are making the market for everyone to engage in the buying and selling of options, they don't think that Robinhood's getting to $25 because Robinhood's at freaking $8. The idea that Robinhood, in my expiration was January 2025, the idea that Robinhood would in a year go up 4x is like not practical, right? Most, and it's not just Robinhood, any stock. The idea that any stock is going to 4x in a year, Palantir, right? Palantir went from 10 to 80 in basically a year and a half. That's why people who had call options made so much money. I mean, I know people who have literally retired because they were right. They said they bought a call option that Palantir would go to $15. Palantir's at 80. The more the stock goes up, the more your call option increases in value because you are right about the direction of the stock price actually going higher. So when I bought Hood options when it was $8 and the stock I was assuming would get to 25, the call options were incredibly cheap, like dirt cheap. Why? Because the odds are you're going to lose all your money. So that's why it's cheap. When you think of roulette, it is much cheaper in roulette when you bet on an individual, or sorry, the risk to reward is much higher in roulette when you put like a black on like number 12, because the idea that the ball is going to land on 12 is like very low, right? The chances of the probability of that happening are low. So if that actually does happen, it's like 30 to 1 on your money or whatever the ratio is because you were right. Kind of the same thing with a call option. If you are out of the money, meaning you are way above the strike price. So right now, Palantir's at 80. If you buy a call option that Palantir's going to get to 120 in like a month, you are going to make a crap ton of money because the odds of Palantir going from 80 to 120 in 1 month, 120 is your strike, 1 month is your expiration. Those are the two parts of the contract that matter, is probably not going to happen. So if it does happen and you're the guy taking that bet, you are going to make a crap ton of money because you ended up being right when basically the market was saying you were going to be wrong. So let's look at that right now. If I go to March 21st and I try to buy a $120 call for Palantir, it's costing me $1.23. That's actually still kind of expensive compared to the fact that people are willing to pay that is kind of wild. But if I wanted to buy a $90 call by March 21st, which is a bit more reasonable if Palantir has good earnings, that's costing me $4.80. So it's costing me 3x less to bet that Hood or that Palantir would get to 120 in the same amount of time, which makes sense because it's less likely that Palantir would actually get to $120 in the next month. So the takeaway here is that when you buy a call option, if you are buying really out of the money, what does out of the money mean? OTM, you're going to see that term a lot. What is out of the money? It means your strike price is significantly higher than where the current price is. Your premium that you're paying, meaning the cost you have to pay to buy the contract, just like I did on Hood when it was $8 and I was buying the $25 contracts, is significantly lower. And the upside is significantly higher. We're talking about 3, 4, 5, 6, 7, 800%, 1,000%, 2,000%. I know some of you, Doug made 2,000% on his Hood calls because Doug was betting Robinhood would be $20 when they were $7, and then Robinhood got to 25. He sold them. He was up 2,000%. Those are life-changing amounts of money because he believed that Hood would be significantly higher than what it was at the moment. If I buy a $10 call on Robinhood in a year when Robinhood's at $8, I'm going to make some money because Robinhood got to 40, but it's not as much money as if I was betting that Robinhood would get to $40 because, again, the premium that I'm paying upfront is a lot higher than the premium I would be paying upfront for a strike price that is a lot further from the current price right now. Melanie says a higher strike price on the call means you pay less premium, but it's less likely to happen. Exactly. Exactly. A higher strike price on the call means you pay less premium. And think about it logically. Why am I paying less premium? Because it's probably not going to happen. I'm paying a less amount of money to gamble because my gamble is probably going to be wrong. So the odds of me being right are so low that the cost to make the bet is also significantly lower. But if I buy a call option for Robinhood at $9 and the stock is $8, reasonably, if Robinhood doesn't tank to $5 and a year from now or a month from now, whatever your expiration is, Robinhood is above $9, I have to pay a healthy amount of premium because the market makers know that the odds of Robinhood going from 8 to 9 are a lot likely to happen versus going from 8 to 25. Okay, let's talk about this as well. So Gene says, Amit, let them know that it's the contract is not actually $4. They have to multiply that by 100 shares. Correct. So that's a really good point to bring up. So the Palantir call option, and again, we haven't talked about puts at all. We're still on calls. We'll talk about puts in a second. The Palantir call option for March 21st, our expiration, $90 strike, is $4.80. Now, that does not mean you are paying $4.80. It is not cheaper than a $5 foot long at Subway. You are paying $4.80 times 100 shares. Why are you doing it times 100 shares? Because every single options contract, no matter what it is giving you the right to control 100 shares. So 480 times 100 is $480. If that was 48 cents, it would be $48. So the $120 call option that's worth $1.23, I multiply that by 100. The actual contract is $123. Now, if I wanted to buy 100 shares of Palantir at 90, if we do some simple math, that cost me $9,000 freaking dollars. That's a lot of money. But if I buy the call option, which is $4.80 times 100, it costs me $480, which is a lot less money than $9,000. However, the big if here, and this is the beautiful thing about options, is you're constantly weighing the risks and rewards against yourself. It only cost me $480 because it's expiring in a month, March 21st. So if I bought 100 shares of Palantir at $90, even if it goes back to 30, if I believe in Palantir and I think it's going to come up one day, I don't actually lose my money. Hopefully, if the company doesn't go bankrupt and they keep executing, right? And realistically, maybe the stock goes to 50, 60, that's the max pain, maybe 45. So like you can handle that loss and you can deal with it because hopefully it's going to come back one day if you believe in the company. If you buy a call option to get to 90 and then Palantir messes up earnings and they go back down to 60, you lose all your money. That $480, it's a lot less than $9,000, but that $9,000 is recoverable one day. You can actually have a chance to get it back in the future. That $480 is gone forever. You're done. That $480 will never be coming back. Raj says, so why not just say 480? Why 480 if the contract is always 100 shares? So the way option prices are calculated are per share. And that's just kind of generally the terminology around it. So when you start talking about options, people are going to say, oh, it's 480 or it's $4.80 a share or it's 23 cents a share. I mean, it's whatever you like to do, right? You can call it $480. You can call it 480 a share. The point is, as long as you know what it represents, that's what matters. Some people use it in terms of its actual value times 100. Some people do it per contract or per share because that's just how they're used to talking about it. There's no real difference between them. You just need to know what they represent when you see them on an options chain. Now, on an options chain, it's not going to show you $480. It's going to show you $4.80 because they're calculating it per share per contract. That's just how option chains are set up. So you just have to know how to read them when you are going through the actual chain themselves. June says, so when you buy a call at $10, you just buy it for a premium or the shares too? You're just buying the premium. That's it. You are just buying. So if Robinhood's at $8 and I think it's going to go to $10, I am just paying the premium for the right, going back to the definition of a call option, the right to own those 100 shares. But 100 times 10 is $1,000. I don't have to pay $1,000 today. In the future, if Robinhood gets to $40 and I want to pay that $1,000 to exercise that contract, then I'm in my right to do so. And then 4,000 minus 1,000, I make 3,000 profit. But I don't have to do that upfront. Which means the other thing besides exercising, because we didn't even talk about this, the final thing after exercising, or if you don't want to exercise, is you can just simply take profits on the price of the new contract, which is what I did on Robinhood in 2025, on January 2nd. I did not exercise my Robinhood calls. I sold them. So I was up about 600% on them. And I said, you know what? I would like to take the 600% profit, and I would like to keep that money in cash. And so I sold the contracts. What did I do with SMCI the other day? I bought 5 contracts of SMCI with a strike price of $50, expiring in January 27. Here's a good example. So SMCI, $50 call, right? I might have been peer pressured by Matt, Steve, and Chris, but nonetheless, this is what I did. I am currently up $165 on this call. Why? Because I bought it at $11.50, which means $1,150. Going back to your question, Raj, why do people say, like, it's just easier to say I bought it at $11.50 versus I bought it at $1,150, right? So I bought it at $11.50, which is actually $1,150, not $11.50. Multiply that by 5 contracts. I paid $5,900 for it. And I'm up $165 because now the current price of the contract is not $11.50, it's $11.83. Which means I'm up 33 cents a contract, which is great. 33 cents times 5 gets you 165. I can sell this right now and make 3% on my money, $165. Now, this is why I love Robinhood so much. You see how they say simulate my returns? We're going to click on that right there. Simulate my returns. And other platforms do this. Robinhood just makes it really easy. Also, before that, you see how it says exercise right below? It says exercise as well. Now, why would I not exercise this? Someone tell me, why would I not exercise this contract? Let's see who can understand this. Why would I not exercise right now a $50 call on SMCI that expires in January 2027? Why would I not? Why would it be the stupidest thing in the world for me to exercise this contract today? There we go. Because it's cheaper to buy shares at the current price because it's not 50. Exactly. So if I exercise this $50 SMCI call, what is the point of exercising? You have the right to buy those 100 shares, always 100 of them, at the strike price. Well, SMCI is at 33 and my strike price is 50. So what dumbass, quite frank, and Robinhood will tell you you're a dumbass. Look, let me press exercise. Okay. So already Robinhood's like, why are you exercising, Amit? Why are you being stupid? And then I say, I want to buy the stock. And then it starts giving me another warning. It's like, hey, wait a second. This is stupid. You should not be exercising, Amit. This is dumb. You have a lot of reasons. They say it's too expensive. They say the time value is high. They say the contract's out of the money. I say, you know what, Robinhood? I don't care. Continue. Robinhood gives me another warning. They're like, dude, you're literally being an idiot. Your contract is out of the money. You're buying it at 50. Your strike price is at 33. You're losing $17 a share. It makes no sense. I'm like, no, I don't care. Continue. They're like, Amit, you're an absolute idiot. Your contract has high intrinsic value. What is intrinsic value? It's the time value of the contract. We have 2 years for this contract. And SMCI is barely over $30. They're like, why do you want to do this? I'm like, you know what? I don't care. Continue. And then they finally say, all right, you can do it. Now, I'm not going to do it because I would like to think of myself as not the biggest idiot in the world. But the point is, you could do it, right? So if SMCI was $80, then it makes sense because 80 minus 50 is 30. So if I'm exercising my right to buy 100 shares at my strike price, which is 50, I'm making $30 a share. And if I'm bullish SMCI and want to hold it for the long term, that's why I would do it. Now, here's the simulate my return. Actually, let me pull this up on desktop because it's easier for you guys to see it on desktop. So we're going to simulate the returns, which is not a perfect calculation on what the SMCI contract will look like in the future, but it's enough of a estimation on where Robinhood's algorithms think the contract will be. So I'm not planning to hold these SMCI contracts for a long time. Quite frankly, I want to sell them pretty quickly because I only bought them so that Steve and Chris and Matt can't laugh at me if they're making money and I'm not making money. So let's say SMCI is a big pump. I'm talking 20, 50, 30% pump. Let's say SMCI gets to $50. You can see right there, I'm entering a price on Robinhood, $50. Okay. And that's a 50% gain from here. So I type that in, 50, enter. Look at the value of the contract. The value of the contract just went up 103%. And I want to sell them on February 4th, which are the earnings, or February 7th. That means on February 7th, and this is the cool thing about Robinhood, you can go by the dates. As you can see, the further out I go, the more the contract declines in value. Why? Because my time value, extrinsic value, I know we didn't talk about that, but just for an explanation, my time value goes down because the contract is getting closer to expiration. The closer you get to your strike price before the contract expires, aka the more time that exists on the contract, the faster the value of the contract goes up. So I paid $11.50 for these calls. If SMCI gets to $50 by February 7th, look at the value of the estimated contract price, $23.38. I paid $11.50. That's up 100% from what I paid. Times 5 contracts, I would be up $5,000. I would take that money. I would sell. I would say, you know what? I don't care what SMCI does in the future. I'm taking my $5,000 and I'm laughing all the way to the bank. Now, let's say SMCI, let's just have some fun with it. Let's say SMCI, this thing got to 120 in March. Let's say it goes back to 120. If it goes to 120 by February 7th, which I don't think is going to happen, I would be up 600% on my money. Now you can see why people really like options, because the leverage that they're getting against the value, the quite frankly, pennies that they're paying to get access to the exposure of SMCI at $50 without having to buy SMCI at $50 is gigantic. And as a result, they could be up 620%. Now, let's say it gets to 120 by the end of the contract, even by the end of the contract. So January 2027, 2 years from now, because my strike price was at 50, which what does that mean? That means I think SMCI can get above 50. And I only paid $11 for the contract, which means realistically I have to get above $61 because you add your premium plus your strike price. And the stock's at 120, the contract is going to be worth 500% more, meaning I would be up $35,000, 5x on my 5,000 or my 6,000, by 2027. That is why options can become very attractive. Now, let's say this thing goes nuclear, bro. Let's say this thing gets to $500. Let's say SMCI really is like going to be the biggest gem over the next couple of years. I would be up tomorrow, February 3rd or February 4th, when SMCI's earnings. I would be up $221,000, which means I would be up 3,000% if SMCI somehow got to $500 by February 7th, which I don't think it's going to happen, but it's nice to kind of see what would happen if it did happen. And by the end of the contract, 2027, because I'm so in the money, because my strike was 50 and the strike and the price is now 500, which means I've 10x on the stock. I have gone up 30x on the contract. So a 10x on the stock, 50 to 500, has allowed me to 30x, 3,000%, or really 40x because it's 3,800, 38x on the underlying contract. Now let's do an opposite example. Let's say SMCI stays at $35 for the next 2 years. You see how all that green went to red? See how all that green went to red? All of that green, all that beautiful green slowly went to red. So if it went to $35 by February 7th, because I bought it when it was $31, I would be up about $600. It'd be nice. It's not really, the type of money that I would be buying these options for in the first place, but maybe, I take that $600 and I leave and I make some of my money, right? At least I don't lose a lot of my money. So the contract would be worth $12.76. I paid $11.50. I make the difference. I make 12% of my money. Not bad for like 3 weeks. That's not horrible at all. But if by expiration, my strike was 50 and SMCI is at $35, meaning it stayed flat for 2 years, I lose, as you can see right there, 99.68% of my money. And on the final day, I lose 100% of my money, 99.99%. This is the beauty and also the tragedy of buying call options. If you are right and the stock keeps going up, you will make multiples on the money that you invested into the call option. If you are wrong, then you're going to lose all your money. You're going to lose all the premium that you're paying out. Now, your losses are limited to the amount of premium you're paying for the call option. Let me say that again. Your losses are limited to the amount of premium you're paying for the call option. So the most I can lose on SMCI over 2 years is $5,800. That's the most I'm going to lose. This is not shorting. We're going to talk about that in another day. But when you short a stock, you can lose unlimited. You can lose like this is why when you hear people saying we got to cover our short, it's because like, you know, you could really lose everything. Like you could be, it's unlimited losses. And they get really, this is why GameStop, when that was happening in 2021, the stock kept going up. You might have had a short at $20. The stock's at $400. If you did not cover that short, you are obligated for lots and lots of shares to pay back to the market. And you have to cover those shorts very quickly. When you cover those shorts, you have to buy back the contracts. That creates even more pressure on the actual underlying stock, which leads to a more squeeze. That's what happens when you hear about a short squeeze. But when you buy a call option, the most you can lose is the premium that you're paying for the actual calls themselves. And that's pretty much what we got on call options. But you can't lose more than the contract price. Correct. You cannot lose more than the contract price. So I put up $5,000 for SMCI. If SMCI is not 50 in 2 years, I will lose my $5,000, which I'm okay with losing, right? That's a calculated bet on my side. It is what it is. If it happens, it happens. But it's not $500,000. You know, I'm not okay with losing $500,000. I'm okay with losing $5,000. And hopefully I don't lose $5,000. I'm trusting Chris, Steve, and Matt that are going to be right about this. And if they're not, we get to blame them forever, which is going to be fun. Quite frankly, it would be a little bit more fun than making some money. But it's all about, as someone says right here, risk mitigation. Risk mitigation to determine how you want to go up or down on some of these stocks. What if the person is a Wall Street Bets degen who can't afford to get it back or who can't afford to get the stock? They're in trouble. They're in a lot of trouble. In fact, you know, I hate to bring this up, but there was a kid in 2020 who ended up taking his life because of how much he was down on options. And ironically, he wasn't even down as much as it said he was down. Like there was a little, like he didn't really read the option price correctly, or maybe it was displayed incorrectly to him. But you know, he felt like he was 20 years old. I think he had gambled with his parents' money. Somehow he got access to their accounts. He put it into his Robinhood, and then he was down like $700K, and he took his life. So this stuff is very serious. Like this is why the preview I did to this entire stream is that the best way to get into this stuff is to use a virtual trading platform like MarketWatch to play with this stuff, to feel confident to even begin putting a couple $1,000s into this stuff. And then once you feel like you understand a little bit more about what you're doing, you've watched hundreds and hundreds of videos, read more books, talk to ChatGPT about it, which is a phenomenal resource. If you can talk to ChatGPT about call options, buying, selling puts, all this stuff, then you take a little bit of a risk. You always have to take a risk, but you don't have to take a $500,000 risk. You can take a $5,000 risk. And I think it's so weird because people say options are taboo. It's like options are taboo if you're an absolute idiot that thinks you should gamble your grandparents' inheritance on Donald Trump call options. Like something's wrong in your head. It's not about the stock market anymore. You're just like, something's wrong in your head to do that. The audacity to waste your grandparents' money that they gave to you before they pass away is insanity, right? That's an individual person issue. That is not an issue with the concept of options. It's just options magnify the losses because obviously you can't get that money back if the stock doesn't go your direction and there's an expiration date, and then you're kind of stuck losing a significant amount of money. But that shouldn't be a reason why people don't try to learn about the craft and do the deep diving and the hard work that it takes to understand options. If that was the case, no one would ever invest. And I know a lot of you guys in Europe tell me all the time, most people don't invest because investing is taboo. In America, it's different. We all want to take risks because that's why America is America, right? Google, Amazon, Microsoft, these companies don't happen unless people take risks, not only from the entrepreneur founder side. Zuckerberg had to take the risk to start Facebook, but Peter Thiel had to take the risk to invest in Zuckerberg in order to give him the capital needed to build Facebook. Why did he take that risk? Because he felt one day Facebook would return his money times a lot more. And that did end up happening. And so when I think it's the same thing when it comes to options. You have to learn about what you're doing. You have to take calculated risks. And then once you feel comfortable enough, you can take bigger risks. And then you keep going from there. How are you making profit on SMCI call when your option is still out of the money? Great question. So again, a call option goes up in value even if the stock does not reach the strike price
of your call option. So my strike price is $50 by January 2027. Let's say SMCI goes to $40. The value of that contract will increase even if I don't exercise the contract. Why? Because even at $40, it doesn't make sense to exercise the contract because SMCI is 50, the stock price is at 40, I'm still losing $10. But the market will be willing to pay more for a contract when the stock is 40 versus when the stock is 30. Why? Because there's a $10 difference in the stock. So the value of the contract, the premium you're paying for the contract, naturally will be higher. How much higher will it be? That depends on a lot of different variables, but it will be higher. And at that moment, if you're like, you know what, screw it, I don't really care about SMCI, I'm happy with the 15% I'm making on my money, I'm going to sell, take my money and leave, you're allowed to do that as well. Let's say SMCI goes to $28. And if SMCI goes to $28 and I'm down 10% of my money, so I'm down $500 on my 5,000, I'm like, you know what? I'm cool. I lost $500. I don't want to play this game anymore. I'm getting out of the game. I'm going to take my $4,500 back, lose the $500, and I'm going to move on with my life. So you can also sell the option at a loss, at a small loss, when you start losing confidence in the direction of the contract based on where you thought the market was going to go. So on August 5th, when I was holding on to a lot of HOOD options with a strike price for 25, and HOOD was at, I think, 24 at the time. So I was very close, right? So I was like, I was up a lot on the contracts, and I was very close to being up a lot more on the contracts if I got above 25. That was on August 3rd. And then August 5th happens, and Robinhood goes to 14. I was down a lot. And because I was down a lot, what I decided to do was buy more, right? Because at that moment, I was like, you know what? I think this is stupid. I think it'll come back. But there were many people in that moment that would have sold, taken the loss, and been like, you know what? I'm done with this game. I don't feel like playing this anymore. Because Robinhood's at 14. It was almost at 25. It's never going to get to 25. Boom. Like, I'm done. I'm going to leave. I thought Robinhood would get back to 25, and Robinhood ended up getting to 40. So that ended up working out. But those are moments where you can decide to stop playing the game and take some of your losses that you have right now. Celsius is another great example of directionality. So Celsius, if we look at Celsius's stock last year, this thing got to $100 by I think March of 2024. May of 2024. It was at $99 in May of 2024. If you bought call options in January when it was 50, you made a lot of money. But then the stock started going down, which means the value of your call options, if you held them because you thought Celsius was going to keep going to the moon and Celsius starts tanking, it doesn't matter what the value of your call options were on May 17th, because by October 4th, if you still held them, you were down a significant amount of money, especially if you bought the contracts when the stock was at 50. You wrote it up to 99, that's great. But then if the stock's at 30, your call options start to lose a lot of their value. Now the stock's at 25, which means if you're still holding those call options with a strike of 99, the odds of Celsius getting to $99 again after falling from 99 to 25 is unlikely. And I know a lot of people that messed up on that trade. I've messed up on trades like that in the past. I didn't end up messing up on Celsius, but everyone has those moments where they mess up on the trade. The question is, are you messing up on a couple $1 million of Celsius calls, or are you messing up on a couple $1,000 of Celsius calls? Everyone's going to lose at some point. The question is, how big of a position are you putting at risk when it comes to these contracts? Can you have stop losses on options contracts? Yes, you can have stop losses. You can have stop losses across the entire board. A lot of time is just trying to mitigate the risk on your stop losses. You can also have limit orders on entering into a position. So I have tons of limit orders on different options that I'm buying. And if the market decides that the stock is going to go down enough to give me my price, then it'll fill. If it doesn't, then I don't have to buy it at that price. Same thing with stop losses. You can set a particular percentage or particular price on where you think the stock, the option should sell off if you think the stock is going to go down. People do this a lot going into earnings to play the volatility. They'll take their quick loss easily, or they'll take their quick win easily. But the point is, it's very similar to a stock with a stop loss. It's just magnified in terms of the volatility because it's an option as well. Doug said he held Celsius for too long. All right, so Doug won big on HOOD and he lost a little bit on Celsius, right? So it is the, as TJ would say, the gimmies and the gotchas of getting into the game of options. Again, not everyone is. Look, I've been really right on HOOD and it made me a lot of money. I expect in the future for me to be really wrong on something. I've been wrong on something in the past. I've never been wrong on something in the options market to a massive degree. Maybe SMCI will be my first one. But I've taken big bets in the past on stocks. You guys know I bought stupid biotech back in 2020, lost like 15 grand on that. But it's never been like, lots and lots of money in options where you lose. I haven't had that experience yet. Maybe lost a couple $100 here in certain options, but nothing to the point where I made a concentrated position of, lots and lots of money, tens and tens of thousands of dollars. I had an expiration date and the stock didn't go my direction. That hasn't happened yet. I'm sure it'll happen in the future because if you do this game long enough, Chris Camillo, Derek, these guys that have lots and lots of money, they've lost lots and lots of money in the market before. I mean, Derek's told me how much he's been down a day, and it's a lot. It's a lot, right? Because he takes some big bets, and sometimes those big bets go the wrong direction. And then you're kind of screwed, and you're like, all right, at least I can save some money on my taxes. But that shouldn't be the fear of getting into option. The broader fear should be, how do I risk mitigate against having that massive loss? Because even though, Derek has taken massive L's before, his portfolio is just substantially bigger that he can handle that. But if you're this kid who got his grandpa's inheritance and you lose $800,000 out of the $1 million that you were given, it's hard to recover from something like that. Cool. Are we good on call options? We haven't even gotten to puts yet. We haven't even gotten to selling options yet, dude. This is gonna be longer than 2 hours, bro. This is gonna be a lot. Are we good on call options? Do we get it? I think we went through a lot of different scenarios here. Is selling before the expiry guaranteed? Like it will get sold for sure? No, you do not have to sell the call options before the expiration. You can choose to do that, but you don't have to. On the day of expiration, your brokerage will automatically sell the call option for you or exercise it for you based on what you tell them to do on the last day of expiration. But you don't have to sell before the expiration. It's literally up to you. If you want to take the loss, take the win, you can. If you don't, then you don't need to. Cool. Yes, we're good on call options. Yes. Okay, cool. All right. Let's get into puts. Puts aren't that different, to be honest. They're pretty much the same. It's just in the opposite direction. So what are put options? A put option gives the holder the right to sell a stock at a specific price before a certain date. AKA, you are betting that the stock is going to go down. And this is a way to hedge against your fears that the stock is overvalued, it is too expensive, there is too much euphoria, and you think this thing is going to collapse. Puts are often purchased by investors expecting a stock's price to drop or to protect against losses. So we talk a lot on the channel on selling puts and what it means to sell a put to gain option premium. And that option premium is then a form of side income, right? We talk about that a lot on the channel. We'll talk about that more in a bit. Are call options losses a tax benefit? Yes. Any losses you get are a tax benefit. So if you lose a lot of money in call options, the benefit is at least you can put that against your taxes. Now, when we talk about selling puts and getting that premium, someone's giving you the premium. Someone's giving you the premium. So when TJ's making $40,000 in a month off of option premiums, he's getting it from someone, right? That's not coming out of thin air. So the way that's coming out of where is that coming from? That's coming from someone who's buying those puts, which is what we're going to talk about now. Selling puts we'll get into in a bit, but when you buy a put, you are buying a contract that is assuming the stock will go down in value. SMCI will go from 30 to 20, and your put will go up in value. Let me say that again. The stock goes down, the put goes up. The stock goes down, the put goes up. The stock price goes down, the put contract price goes up. So when you buy a put, you're essentially saying, when you buy a call, you think the stock's going to go up. When you buy a put, you think the stock's going to go down. I mean, that's like, if you take nothing away from it, when you buy a call, you think the stock's going to go up. When you buy a put, you think the stock's going to go down. And even just understanding that means you know more about options than 99% of the world, because most people don't understand that basic fact. So that's what a put option is. If you're buying a put option, you believe those shares will eventually go down and the value of that put will go up. V-Raj says, what do you mean you bought more? Didn't your contract expire? No. So when I bought more of the Robinhood contracts, the expiration was January 2025. We were in August 2024. So I still had 8 months on the contract or 5 months on the contract to get to my strike price. So I bought contracts that day, assuming that $14 dip on Hood was a nothing burger. And luckily I was right. And everyone was right who bought the dip on August 5th. And, then the stock went up and then I got to sell by expiration. But if those contracts were expiring on like August 20th, then I would have been in a bad situation because Robinhood probably wasn't going from 14 to 25 in the matter of 3 weeks. Matt Money says, think about when you are making a phone call. To make a phone call, you pick up the phone or you put the phone down. Correct. That's a great example. When you make a phone call, you pick up the phone. You make a call, right? You're calling, you pick up the phone. To end the phone call, you put the phone down. And so when you put the phone down, that means theoretically you are assuming the call is ending, aka the strike price or the stock price. The stock is eventually going down. Erwin says you pick up the phone to make a call, you put down the phone at the end. Correct. Erwin said he copied Matt. The fact that you guys both thought of that at the same time is good. Both of you guys got that same example. So let's do an example. Let's do an example on puts. Let's say that let's do Nvidia. Let's do good old Nvidia that tanked on Friday because people can't give Jensen some time to deliver his results. Let's say Nvidia's earnings usually on February 28th. I'm going to do a March 7th put. So I'm going to go to Robinhood. This is any option chain. You can press buy put. So I'm going to let me just do this on. Why do I keep doing it on my phone? Let me do it right here. Okay, so let's go to Nvidia. And we're going to go with buy put. And we're going to go to March 7th. Okay, so let's pull this up right here. So this is an option chain, very similar to what other websites will look like. Robinhood, I think, is the easiest UI to interact with it, but nonetheless pretty similar. You have your strike price, you have your delta, which we're not going to talk about today. You have open interest, that's just how many calls or puts are open. You have the percentage change, the change in the price, and then the bid price. The bid price is the actual value of the contract. So if I want to buy a put on Nvidia, because I think Nvidia's at 142, I think Jensen's not going to deliver the goods. I think this sucker is going back to 125. I can pay $2.69, meaning $269, $2.69 times 100. And I can pay $269 for the right to buy Nvidia shares at $125 because I think that it's going to go down. And if I think it's going to go down, then ultimately I have a better chance of owning Nvidia at a smaller price, which is a good thing, right? Because at that point, Nvidia ends up going down, which means my contract value ends up going higher. So let me go through an example right here. So we did what? 200, we did 125, 269. So this is what the example looks like right here. Sorry, I mean sell. Sorry, I mean sell. Not buy shares at 125. Sell shares at 125. Yes, sell. Buy is for the call. Sell is for the put. So I have the right to sell those shares at $125. So this is what it looks like right here. This is your max profit, max loss, and your break even. So if I am buying this contract, the way I get green is when Nvidia goes down. As you can see, the price of Nvidia is going down, and I am making more money. My expected profit and loss right there is going up on the top as Nvidia goes down, which means theoretically I can make $12,000 off of a $269 investment. That is my max loss versus my max profit if Nvidia goes to zero. Now, is Nvidia going to go to zero? Probably not. I don't think Nvidia is going to zero. Even though Matt Money always says, certain stocks go to zero. I don't think Nvidia is going to zero. But if Nvidia goes to 120, I make $177. And if you multiply this times, tens of thousands of contracts, this number gets a lot bigger. If Nvidia goes to 115, 116, I make $585 off of my $269 investment, which means I basically doubled the amount of money because the stock keeps going down. However, if the stock goes up, I lose all of my put premium. Just like on a call option, if the call option does not get to your strike price, you lose all of your premium by the expiration. If by expiration, March 7th, NVIDIA is at 150, 130, if it's even at 125, you are losing all of the premium you paid to buy the put. All of the premium you paid to buy the put, which is obviously not a good thing. Now, someone is asking, why is the break even at 122? The break even is at 122 because the strike price is 125 and I paid 269 to buy the contract, which means actually my break even, the way I start making money is when NVIDIA gets to 122. Just like on the call option, we talked about Nancy. She's buying a $150 strike price on Google. She's paying $50 of premium. So by January 2026, she needs 50 plus 150 to be 200 for her to make money on her call option on Google. If you're buying a put option on NVIDIA, it doesn't just need to go below 125. It needs to go below $122.31 because you already paid $269 or $2.69 a share to buy that contract in the first place. So it doesn't make sense, right? If NVIDIA is at 124, you're not going to make any money because you already put up $269 to get the contract, which means the contract needs to go below the amount you're paying minus the strike price, 125 minus 269, aka 122.31, for me to really start making some money. So let's do a simulation on this example to get a better understanding of this as well. So I'm going to add this to my watch list. And now I can simulate my returns. Does that make sense? Does that make sense? It's like cheating death. Yeah, to an extent, it's like cheating death. The break-even price is the amount you're paying, the premium you're paying, always on a call option or a put option. There's always a break-even. That break-even is usually the amount you're paying plus or minus the strike price, plus for the call option, minus for the put option. Subtract that from 125. Now you get the actual price you need NVIDIA to get to in order for you to be able to make money or lose money on the trade. And as Roji says right here, we'll talk more about that in a second, you're paid $269 because you're selling the puts. We didn't get into selling puts yet, but technically there's someone who's collecting that $269 that you're paying that $269 to. We're discussing buying puts right now, Raj. We're not discussing selling puts. We're discussing buying puts. So here's my simulated chart of NVIDIA. Let's say by March 21st, NVIDIA goes to $100. Let's say Jensen absolutely craps the bed and NVIDIA tanks. I am going to make a lot of money. So by the end of that contract, as you can see right here, I'm going to be up 891% or $2,270 on a $269 investment because NVIDIA tanked the bed and my break even was 122. NVIDIA ended up going to 100. Ka-ching, ka-ching, ka-ching for me because I have just profited off the downside of NVIDIA stock because everyone thought it would go up. I said it would go down. It ended up going down in a spectacular fashion. Therefore, I make a lot of money. Now, let's say NVIDIA only gets to 120. I'm still going to make some money. It's not as much as I would make if it went to 100, but I'm still going to make 97% on my money, as you can see right here, which is $787. Remember, the estimated price of the contract was $2.69. Now, if NVIDIA gets to 120, my break even was 122. The estimated contract price would be $10.42, which is 308% above the price I paid to buy the put. Now, let's say, so that's good, right? Let's say NVIDIA goes to 170, which I hope it does because I'm a shareholder of NVIDIA now. I will lose all my money. So within the first days of the contract, I will be down 90%. Why am I down so much? Because mathematically, if NVIDIA is at 170 and my break even is at 122, the odds of NVIDIA falling $50, which in NVIDIA's case would be about NVIDIA shares outstanding, $50 would be... that's over $1 trillion, essentially. I think it's like $1.5 trillion of market cap. The odds of them falling $1.5 trillion in market cap is very low, right? Because they have 24 billion shares outstanding. So immediately the market makers would price down the probability of this contract being in the money, aka getting to that 122 break even that I needed to get to. And instantaneously, I would be down 90% of my money And then slowly but surely, I would be down 100% of my money as we get close to the expiration date. So a lot of times, if you have a short expiration on your call or your put option, you've got to be right really quick. And if you're wrong, you don't have time for the option to recover, because if you only have 30 days to expiration, which is why I don't buy short dated calls or puts, I sell them, and we'll talk about that coming up now. But if you buy them, you're screwed if the stock doesn't go in your direction. I like buying leaps, which is just another word for long dated contracts that expire in the future. And so with Robinhood, I bought leaps when it was in December 2023, and Robinhood got the expiration was January 2026. And I'll show you those guys right now. I showed you them already, but let me show it again. That is where there is a lot of money to be made. If you are correct about the contract price, and you're correct about the time in which it's going to happen. So these are my leaps on Hood. Again, we still have another year for them to expire, so we got a lot of time on these. They are up $129,000, 469%. And they had a strike price essentially of $20. It's a spread, but we're not going to get into that. It was a strike price of $20, which means my break even on Hood, actually, because of it's a spread, was $15.79. But realistically, based on how I want this to happen, it's more like $20.79. So I needed it to be basically 21 bucks. Hood is at 51 right now. So as you can see, the contract has materially moved in a much higher direction. And when I sell this contract, I'll be able, as long as Robinhood doesn't collapse below $21, I'll be able to make some money. And I have until January 2026 for Hood to be above $20. Now, when I bought these, Hood was $8, and they were really cheap. They cost me 79 cents in December of 2023, with an expiration of almost 2.5 years, with the assumption that Hood would not be at $8 in 2026. And now Hood is at $51. The contracts are worth $4.50, which is up 470% from the premium I paid to buy them. If Hood was still $8, obviously they wouldn't be doing as well. But the point is, when you have time on your side, you can actually win in options, because if you're right about the stock, right about the direction of the company, right about the overall thesis of the company, and you have time to magnify and like kind of deal with the volatility of things that will happen over the next 2 years, although you have to wait, and it's not like the dopamine of getting 1,000% in 1 month, which, you know, the stock market should not be considered Vegas. So that's not something people should be going for. If you can wait 2 years and make 500% on your money, I mean, most people can barely make 20% of their money in 2 years, right? Most financial advisors, you know, they barely get 10% per year. So 500% on your money is phenomenal, even if it takes 2 years, but you're giving it time to mature, which is the beauty of long dated call options. Okay, cool. That's what we got on buying puts. Any questions at all on buying puts? Now we're about to get to selling puts, which is my favorite part of options. We got my uncle in the chat right here. He says, we need to get to selling puts. That's fun. Reoccurring income on margin trading, something that I didn't even know 3 months back. Credit to Amit. My uncle has literally changed his life with selling puts. We're going to go through the bear case of selling options, but there is a massive, massive bull case. And I think the people that constantly say selling options is wrong, or they don't like the process or the strategy of selling options, I think they buy into the propaganda of people that sell options on junk companies and lose all their money, which a lot of that happens. But if you just don't do that, and you can be disciplined enough to not do that, this is a phenomenal way, in my opinion, especially in a bull market, because it's a bullish strategy when you're selling puts, to create reoccurring income and for your downside to be limited to just owning more shares of a stock that you like. That is kind of my take on it. As Matt says right here, selling puts in a bull market is easy. He's correct. And look, here's the thing. We talk about it on the Market Open every single day. We are assessing, is there a bull market? Is there not a bull market? Given the Trump presidency, whether you like him or not, I think in the next 4 years, we are in a bull market. Now, will it be volatile? Of course. Will stocks go up and down? Of course. Will we probably have another August 5th event? Of course. But the point is, if you assume the next 4 years are theoretically the golden age for America, and this AI revolution is real, and you don't think it's a bubble, you don't think it's fake, and you're bullish on Bitcoin becoming this brand new crypto industry with Trump with these executive orders, yada, yada, energy, AI. There's a lot of reasons over the next 4 years to learn about selling options because the potential to use them as a way to generate income in a bull market is massive. And if you think we're in a bull market over the next 4 years, then it doesn't mean you're going to be stripped of risk, but it does mean these are strategies that can be utilized in a meaningful way. By talking about covered calls and puts, he is going from lesson 1 to lesson 5. Yes. So I'm going to try to make it as simple as possible because at this point, dude, I've explained selling calls and selling puts to my sister, to my uncle, to my cousin, to my dad, to my mom, and to lots of friends that I have that are into the stock market, but they're not really into selling options. And, you know, they've started to really make some serious money doing this. So I think I can explain it in a way that doesn't sound super scary or intimidating. But we're going to go through the basics of it because I think on an options 101, it's at least important to understand the value of buying options versus selling options because there is a massive difference and it's time for us to kind of dissect what that difference is. Okay, cool. So we talked about buying calls. We talked about buying puts. We talked about all the different scenarios of buying calls and buying puts. Now we are going to get into selling options and we're going to start off with selling puts. Okay. What is the point of selling a put? We'll do puts before calls because I think that'll be easier. All right. Selling a put generates income and obligates the seller to buy the stock at the strike price if assigned. This is often done with cash secured puts to acquire stocks at a discount. That is the academic definition. Let's get into the real world definition. If I am bullish on a stock, meaning Robinhood, I want more shares of Robinhood. You can do two things. You can either buy a share of Robinhood right now at $50.95, where we'll use 100 because all contracts are in increments of 100. So we'll use 100 for the example. I can buy 100 shares of Robinhood right now at $51 and pay $5,100. Or I can say, you know what? I think 51's kind of extended. I like Vlad. I like his shoes. I know Amit is super bullish about Robinhood, and I get it, but I kind of missed the run from Hood from $8 to $50. I don't feel comfortable paying $51 a share. I think Hood's extended. I think it'll go back to 45. It'll go back to 45. I think it'll go, and if it goes to 45, then I'm interested in buying Hood. Let's say you come to that conclusion. Okay. Can you get paid by the market to then have the obligation to buy those shares at $45 if you have already come to the conclusion in your mind that $45 is a reasonable price to pay for Robinhood? The answer to that question is yes. And the way you do that is through a cash secured put. A cash secured put is you selling a put at a certain price. How do you sell a put? You go to your brokerage and you literally press sell put versus buy put. You press sell put. And then you will have to complete some obligations that your brokerage will ask of you in order to qualify for the benefits of selling that put. Now, why are you selling that put? Because someone thinks Robinhood's going to 45, let's say in a month, that'll be a month for our expiration, and they want to profit off Robinhood going down. So someone might be out there thinking, you know what, Robinhood's extended, it's at 51, and I think this thing is going down. I want to buy some protection. I want to buy the put, and I think Robinhood will end up going down to $45, and I'm going to make some money from 50 to 45 when it goes down. You might be thinking, you know what? I don't think Robinhood has to go to $45. But if it does, I'm perfectly fine with buying 100 shares at $45. So is there a world where I can be the seller of this put option to somebody out there that is bearish on Robinhood and is buying that put option? And can I be right and that seller be, or that buyer be wrong, and I profit in the middle of that spread between the buyer and the seller? That is what it means to sell a put. So let's get into it right now. Let's do this and let's see what it looks like in a realistic sense. Let's say in 1 month, so let's go to February 28th, which is 34 days from now. I think Robinhood's not going to have the best earnings, And I think Robinhood's probably going to go to 45. Or maybe they have a great earnings, but I still think the market's going to tank them because they've been on such a good run and they probably can't continue to get to those levels. So I press sell put on Robinhood. As you can see right there, it's the green is on sell, the green is on put, expiration February 28th. And I scroll down to $45. That's the price that I have told myself I am comfortable buying Robinhood at. The market, aka the buyers, are paying you $1.65. $1.65. That means if we multiply that by 100, because every contract is 100 shares, I can make $165. When I say I can make it, I mean I can get that in my brokerage account today. Not tomorrow, not a year from now. Today, I can be credited $165. This is very important because when you're buying puts or calls, you are debiting, you are paying a debit. In this case, you are getting a credit for $165 to sell that put to someone else. Now, do I get $165 out of thin air? No. The way I get that $165 is by securing the put with some cash because it's a cash secured put. Now, what is the value of this cash? How much cash do I have to put up? How much cash needs to be there for me to qualify in 1 month by February 28th for this $165? And then we'll talk about the conditions on actually collecting that $165. You take your strike price, which in this case is 45, multiplied by 100, 4,500. So you are obligated to put up $4,500. Your brokerage is going to take that money from your cash and they're going to use it as collateral. Why are they using it as collateral? Because, and here's where the actual lesson comes in. If Robinhood drops below $45, you have an obligation contractually to buy those 100 shares at $45. I don't care if Robinhood's at $8. I don't care if Robinhood's at $30. I don't care if Robinhood's at $44.99. If it is below 45, and this is, I'm being serious about this because if you are going to sell a put, you have to have this ingrained in your mind. If it is below, even by a penny, your strike price, you are obligated to buy those 100 shares. Now, there's nuances to this, like rolling the contract, break evens. We're not going to get into that today because it's going to get way too complicated. That's the basic thing everyone needs to understand. If it is below your strike price, you have to buy those shares. Having said that, you're getting paid $165 to put up $4,500, which, let's do the math. 165 divided by 4,500 times 100 is 3.6%. There are not many businesses on the face of planet Earth where you can make, let's just round up to, let's just say 3.5%, 3.5% on your money in 28 days. Let me say that again. There are not many businesses in the history of planet Earth where you can put in $1 and get 3.5% on that dollar in just 28 days. The S&P 500 barely goes up 8% a year. Last 2 years have been really good, but barely goes up 8% a year. We'll call it 10% a year over the past 100 years. You are making a third of what the S&P compounds in 12 months in 28 days, which is very, very exciting from a market opportunity perspective and from an income perspective, because if you're playing with millions of dollars, making 3.6% a month, if you annualize that, 3.6 times 12, that is 44% a year. That's a lot of money. 44% a year is crazy. It's not 7,000% on the SMCI leaps that we saw if SMCI gets to $500, but SMCI has to get to $500 for that to happen. In this case, Robinhood just doesn't have to go below 45. So if Robinhood, again, I'll say it again, if Robinhood, based on your strike price and your expiration, is above $45, even if it's $45.01, you are good. You do not have to buy those 100 shares. So if the stock goes up, aka it's above 45, you don't have to buy the shares, which means what happens? Your brokerage gives you back the $4,500. And now you get to keep the $165. Now, let me give some nuance here. When I said you sell the put and you get the $165 credited to you immediately, that's correct. You can open your brokerage account And if you had $1,000, you will see $1,165. However, that $165 is not literally yours yet, because the contract needs to expire for you to keep the $165, which is the difference between getting premium and collecting premium. Getting premium means, okay, the brokerage, your Robinhood, Schwab, Fidelity, whatever. They were like, okay, so you gave us 4,500. We're going to give you 165. You can do whatever you want with that 165. You can go take it out of your brokerage. You can go buy some ice cream. You can go buy some other stocks with it. You can do whatever you want. But by February 28th, if we need some of this money back, you better be ready to give that money back. Or if you want to close the contract before, and again, we'll talk about this in a future session because it goes deeper, but if you want to close your put before February 28th, which you're allowed to do for a loss or for a gain, depending on where the stock goes, you might have to give back some of that $165. You collect 100% of the $165 if Robinhood, in this example, is above $45 by February 28th. You will collect some of that money. You might collect 80% of that 165 or 70% of that 165 as Robinhood stock keeps moving up and as the contract keeps expiring, because you're getting closer to the end of the expiration of the contract. But you do not keep all of it until the final day where the contract theoretically expires worthless, which what does that mean? That means if Robinhood's above 45, contract's worthless. You don't have to do anything. You don't have to press anything. You don't have to press any buttons. You don't have to close the contract. If Robinhood, let's say Robinhood's 51 by February 28th, you have to do nothing. You will just get your 4,500 back from the brokerage. That's the 4,500 you used to secure the cash for the put. And then the 165, you already got it. You don't have to give any of it back. Now you know for sure it is yours forever, minus the 30% you're going to have to pay to Uncle Sam, because that part is inevitable. But that 165 will be yours and you'll be able to keep it. Amit, what if the price is above your strike price? Does that mean you have to buy those shares? Example, if SMCI is at 55 after earnings and your strike is at 50, but expiration is at 2027. No, that does not mean you have to buy those shares. So if I had a put for SMCI with the 50, 55 doesn't make sense. But if I have a put for SMCI at 30 and SMCI is at 35, I'm winning on the put. I said SMCI wouldn't go below 30. The stock's at 35. I can either close that contract, give a little bit of my premium away, and then keep the rest of my premium. Why do I have to give some of the premium back? Because if you're closing it before the contract ends, that means there's time left on the contract called extrinsic value, which means you can't collect all of the 100% of the premium. But if I wait until the expiration, I can then collect all of that premium if SMCI in this example continues to stay above 35 or above 30, which is my strike price. For example, if it's at 35. On the call option, if that's your question as well, no, you don't have to do that either. So if SMCI is at 55 and I have a call for 50, I don't have to buy any shares. I can exercise if I want to. It's just if you have 2 years, till your expiration, usually people don't exercise a contract 2 years early because there's so much extrinsic value on the call option that it doesn't make any sense. So if my call option for SMCI by January 2027 is 50, and then by March 15th, the stock is 55, I can just sell the contract, or I can just sit back and wait and let the contract continue to gain value as SMCI goes up in value, hopefully over the next 2 years. But you don't need to exercise it because you have 2 years left, so there's no point of exercising. So going back to the example on Robinhood, again, we're going to go through it to make it even more simpler for everyone that is still confused. Robinhood stock, $45. Today it's 51. You, as the seller of that put, the cash secured put, are saying this thing's not going below 45. The buyer is saying it is going below 45. So you're in a war with that buyer. You and the buyer disagree fundamentally. That buyer thinks it's going lower. You think it's going low, but not as low as the buyer thinks it's going below, aka 45, which is in the middle of you, the seller of the put, and then the buyer of the put. That buyer is paying you $1.65, $165 per contract, because they're thinking, okay, I'm willing to pay this $1.65 because I think Hood's going to go down. And when Hood goes down, guess what? That $1.65 goes up in value, which means the put buyer is going to win. However, as long as you, the seller of the put, even if the put goes up in value and you're theoretically losing on the trade, as long as by expiration, Robinhood, in this example, is not below $45, you get your $4,500 back in collateral, which how do we get $4,500? $45 for your strike price times 100 gives you $4,500, and you keep your $165. Which means off of 4,500, you have made, again, 3.667% on your money in the stock market. Now let's exacerbate this example with 1,000 contracts. Let's say I had 1,000 contracts times 4,500. I'm putting up 4.5 million in collateral. Some people have big accounts are able to do this. Someone like TJ, I don't think he's ever put 4.5 million in collateral, but he's put up a couple million in collateral, right? Because he has the money and he puts up a lot of money in collateral. Let's do 1,000 times 165. It's $165,000. So on 4.5 million to get 165,000 is not the worst thing in the world. Now, let's say, the point of that example is showing you how big these numbers can get when you're playing with a lot of money. And this is why option selling, for the most part, you get into this. You can get into this if you have a small account, but you realistically, to just be dead honest, you need multi-six figures to do this business, like in a meaningful way, right? You need, I would say, at least 100,000 to get started, and to really make it worth your time, about 250. And if you don't have that money yet, that's okay, right? You got to work to build up that money. I didn't have that money a couple years ago. I worked to build up that money, and now I'm able to sell puts with using a bit more money. But if you only have $10,000, you can still do this. It's just going to be, you're making $30 or $40 in a month instead of $3,000 in a month, which is okay. But 30 to 40 bucks is still pretty damn good if you're doing it off a small base, even if it's not a couple $1,000s. Now, let's say Robinhood is below 45. What is your break even here? What is your actual cost basis on the shares? How do I get to my realistic adjusted cost basis, which I know a lot of people hear that term. What does that term mean on these shares? I take my strike price, 45, minus 1.65, which is the amount I got paid for the premium, the amount the buyer paid for buying the put, and I subtract them, and I get $43.35. $43.35. So as Jose says right there, theoretically, your collateral is not really 4,500. It's 43.35 because you just got 165 bucks. Which means if you are selling a put on Hood and you don't feel comfortable buying it at 51, you feel more comfortable buying it at 45, you're not actually buying it at 45. You're buying it at 43.35, which is even better. If you're bullish on Hood and you agree that 51 is expensive, but 45 is cheap, well, 43 is smaller than 45. So 43 is cheaper than 45 in terms of your ability to get a good, which is subjective. Some people may think that's a good cost basis. Some people may think that's a horrible cost basis. But to you, this is why investing is very personal. If you think $43.35 is a phenomenal price to pay on Robinhood stock, the beauty of option selling when it comes to puts is your downside is limited to you simply owning shares of a company you want to own. Now, having said that, what if Robinhood tanks to 30 bucks? What if Robinhood tanks to 30 bucks? Let's say it completely goes lower than your strike price. Your strike price was at 45, adjusted cost basis was at 43.35. Robinhood goes to 30. Let's do your adjusted cost basis minus $30. You would be down $13.35 a share. That's not fun. That's not fun at all. And if you multiply that times, let's say 1,000 shares, if you had 100 contracts, you're down 13,000 bucks. However, it's a big however, the difference between selling a put and then getting assigned the shares, literally getting put the shares on you, right? If the stock goes below your strike price and goes below your break-even price. And the difference between that and then buying a put or buying a call is that when you buy the put and buy the call, if it goes against you, if SMCI doesn't get to 50, or if whatever stock you're trading, NVIDIA doesn't get to 120, NVIDIA doesn't get to 170, you lose everything. Everything. All the premium you put up to either buy the call, buy the put, it's gone forever. Honestly, it's gone to the person who sold you that put and that call. It was a transfer of wealth from you to them, and it's over. You lost your money. On selling a put, even in the worst of examples where Robinhood tanks to 30, let's say Robinhood tanks to 25, right? And your strike price was 45, break even to 43.50, and you're down basically 20 bucks a share. If you believe in Robinhood and you think it's going to come back to $40, you have not lost your money. Just like if you buy a stock and it goes down and you're sitting on paper losses, you are not actually losing money. You have not took the loss to the point where it's counted on your taxes, because when you buy or sell is officially when you book the loss in the P&L or book the profit in the P&L. You are just sitting on a paper loss, just like many of us have sat on, just like a lot of us have sat on paper losses on Palantir when it was at $6. We weren't losers. We were just early. We weren't really losing. We were just, we were just a little early to the party. No one showed up to the party. We were just a little early. And then the S&P 500 showed up to the party, and then we became really big winners, right? So in this scenario, the beauty of option selling, the reason why I love option selling is because although you're putting up 4,500 to make 165, which some people would say is stupid. Why are you putting up that much money that you could theoretically lose? Again, what does it mean to lose it? It means the stock goes to zero. You don't lose that 4,500 unless the stock goes to zero. Let me say that again. You do not lose the 4,500 of collateral you put up unless the stock goes to zero. Because even if the stock goes to 10 on Robinhood at 40 and you're down 70%, you could make that money back. And on a really good company, Robinhood's probably not going to collapse 70%. On something like GameStop and AMC, good luck, right? This strategy is not really good for those types of companies because those companies are garbage bullshit companies. And if they go to zero, you're done, right? And they actually do have a chance to go to zero. But on something like a Palantir, NVIDIA, SoFi, Robinhood, Rocket Lab, Google, Amazon, Facebook, Meta, right? All these companies are likely not going to zero because then there will be a problem with America if these companies go to zero, which means you can withstand waiting for those stocks to rise, even if you were buying them or getting assigned them on the cash secured put at a significantly higher strike price. That is the difference between buying options and selling options. And we're going to talk about selling covered calls in a second. But buying a put and the stock not going down means you lose your premium. And you might be okay with that because a lot of times people are buying puts for insurance. They might have 100,000 shares of Robinhood and they buy 20,000 puts just in case Robinhood comes down. If Robinhood goes up 30%, they're okay losing that money because their actual shares are going up so much. And that's the whole nature of hedging against the big portfolio. Hedge funds do this with hundreds of billions of dollars. But on the seller side, if you have to buy 1,000 shares of Hood at $43 as your break even, and then Hood goes to $42, you're going to be down a couple bucks a share. And Hood goes to $35. You'll be down 10 bucks a share. But eventually, if you think it comes back, you're not really losing money. Again, let me say that again. You are not losing your money if the stock comes back, even if in the short term you are down. If you're buying a call and buying the put and it doesn't go in your direction, you lose your money. That's it. Now, having said that, is the premium that you're losing when you're buying a call or buying a put significantly less than the collateral that you are putting up to sell the put? Yes. So for example, if I buy a call on Robinhood to $60 and Robinhood's at 50 and it costs me $3. So it costs me 300 bucks expiring in a month, and Robinhood gets to 52, right? So obviously Robinhood did not get to 60. I lose my $300. That's all I lose. I lose my $300. Versus if I sell a put at $50, which is how much collateral? 5,000, 50 times 100. And then Robinhood goes to 45. So now I'm obligated to buy those 100 shares at 50 because it went below my strike price. I am technically spending $5,000 minus the premium. Let's say I got $200 in premium, minus $4,800 versus minus the $300 that I lost on buying the call. However, that $4,800 that you're losing, you're not actually losing, because if Robinhood goes to 45 and you bought it at 50, if you think in a year Hood's going to be back above 50, you're not losing that money. Are you taking more risk with more money, or are you taking sort of less risk with more money? Therefore, the risk might not be as warranted. Some people would say yes. But in the call scenario, you lost the 300 and you're done. And now someone might be saying, well, wait a second a minute. $4,800 on losing on being wrong on the direction of the put and then having to wait for the stock to go back up is worse than losing a measly $300 on buying a call and then being incorrect about the price of where that call goes. That's one perspective. My counter perspective would be, how many people actually know the exact direction of a stock in a certain amount of time that can 100% that with 100% accuracy can predict exactly where the stock is going to go? Because that's what you're dealing with when you're buying a call. When you're buying a call, you are dealing with the idea that the stock must get to my strike price plus my premium in a certain amount of time. And if not, I lose my money. Whereas with a put, if I'm selling a put at $40 and Robinhood's at $50, I have $10 of room to breathe. And the best thing is I'm getting paid to breathe in that room of $10. And then if Robinhood happens to collapse from 51 to 40, I am more than happy to spend my collateral buying up those shares because I wanted those shares anyway. I wanted those shares anyway. And so someone who says, buying a call is easier because you're losing less money, my argument is that the batting average of you buying weekly or monthly calls successfully and getting exactly where you think the strike price or the stock is going to go to benefit from your strike price prediction is simply less. You might be a really good trader. There's some people who are really good at doing it. Most of the world is not. And if you're not, your batting average is going to be significantly lower than selling puts on stocks you already want to own, which means your downside is a lot more collateral than the premium you're paying on buying the call. But you're not losing that premium. You're just simply holding on to shares. You might be bag holding some of those shares, but those are shares of a company you want to own in the first place. And that's the difference of opinion I have with some of the other people out there that don't believe in wheeling. I just fundamentally disagree with them. The idea that you can buy a call on a stock and it's going to go in your direction, quite frankly, is gambling. Now, it might be sophisticated gambling if you really know. Like on Robinhood, I was gambling when I bought those call options last year. But I would say I was sophisticatedly gambling because I had pretty good, at least reason in my own intuition to believe that at $8, the stock was severely undervalued and this thing would go higher. And then I got lucky as Robinhood executed and it worked. But most of the time that doesn't happen. Most of the time it is safer to say, hey, I think the stock's not going to go down 20%. And if it does go down 20%, I'm fine with buying it. And if the stock doesn't go down 20%, boom, I just collected, in this example, 3.5% on my money in 28 days. And the worst case scenario was that I had to buy the shares. That's not the worst thing in the world. Amit, are you implying selling options isn't gambling, but buying is? No, both of these are forms of gambling. However, I would say the person buying the options is the person that goes to Vegas and is betting on black, betting on red, betting on a certain number in roulette. The person who's selling the options is the house. It's a form of gambling. It's just a different form of gambling. Now, can you be super aggressive with your cash secure puts, super aggressive with your covered calls to make it to the point where it seems like gambling? Of course. Everything can, if you have a strike price that is way out of the money, yada, yada, like, of course that can happen. However, the house is only trying to make 2 to 3%, right? They're just trying to keep their money and get a little bit of it because you've got a million casino tables, or a million poker tables, million blackjack tables at the Wynn. And the Wynn is just trying to win and make sure that they keep more of their money than they pay out. The gamblers going to the Wynn are trying to make 1,000% in one night. Are trying to make, they're trying to bet on black and hopefully it goes on black, bet on red, hopefully it goes on red. They are quite literally giving it a sense of probability, a sense of chance. The stock market's a little different, right? Because if you have a strike price, you think Robinhood can get to a strike price counter. Like there's more nuance to the gambling, but nonetheless, it is gambling. When you're selling the option, you are selling that gamble to the person who's willing to take it. And if it goes the wrong way, the difference between the seller and the buyer is the seller doesn't lose everything. The buyer loses everything. And that is the difference. Both forms of gambling. One of them to me is more sophisticated in terms of being the house versus being the gambler. But one of them is definitely being the gambler, even if they're also a very intelligent gambler, which I would say buying put options. It's funny. I remember I posted on Twitter a year ago and people were like, oh, this is irresponsible. And I'm like, no, you're just stupid. This is not irresponsible. In my opinion, not buying options on Robinhood at $8 is irresponsible because this thing is definitely going up. Now, granted, was luck involved? Yes, I agreed. But at the end of the day, there was a lot of logic to why buying the options versus buying the stock at that moment made sense. And this is omnipresent throughout many different forms of the market. At $10 on Palantir, I was an idiot for not buying options, given how bullish I was about the company. In 2 years, aka 2025, when it was 2023 or end of 2022, and Palantir was $5.84 at its lowest, I should have realized, hey, this thing was probably going to be $10 in 3 years. And if not, then everything I've been saying about Palantir is wrong. If it's not $10 in 3 years, everything I've been saying is absolutely wrong, and I've got the company completely incorrect. Which means the leverage I could have got by buying those options off assuming Palantir would go from $5 to $10 was significantly greater than just buying the stock at $5 and having it go up. So there are moments where buying the options is making a lot more sense than actually buying the stock, even if it is a form of gambling. My beef with some of the people that hate option selling is that they think you can consistently buy options, aka buy calls on individual stocks, and that you're always going to be right. And I'm humble enough to realize, look, I got lucky on Robinhood, even though I think I was really smart to get that one right. I'm probably not going to be able to do that again every single freaking year, every single month, especially if you're doing weekly, monthly options. But selling puts, there's consistency there. There's premium there. There's a business model there. There's the potential, if you're able to do it on the right stocks and you're able to pick the right strike prices and you're able to not be too aggressive with how you try to get in terms of collecting premium, there is the potential to rinse and repeat every single week, month, year, however you plan to do it. But with buying, it's much harder. With buying, it's much harder. It's much harder. If you bought shares only, your tax bill for 2025 would be smaller. Yes, that is correct as well. Like if you do option selling in a non-tax benefited account, aka like, you know, like a regular tax account, not like an IRA or a solo 401k, et cetera, you're going to be paying 30%. You're going to be paying short-term capital gains tax, and it sucks. And that's something you have to factor into your income. But I don't think that's a reason to not do it. I mean, look, the taxes are taxes, right? You got to pay taxes at the end of the day. If you're making good money, you got to be ready to pay taxes. It is what it is. And there's a lot of strategies to mitigate taxes, right? And like that, you know, you have to consult with a tax attorney and try to understand all this stuff, your CPA, all that stuff. But having to pay 30% taxes to me is not a reason to not sell options. It is one of just the byproduct of the fact that you're making short-term income. Buying and holding is always the best way to avoid paying taxes for the long term, right? Because you're holding stocks for a long time, but you also don't have access to that cash. If you bought Palantir at 8 and you're selling it and it's at 80 and you're up 10x, you don't have access to that money if you don't sell. And until you sell, that money is just sitting on your brokerage account. You can't do anything with it. If we're talking about using options as a form of income, as a form of then taking that money and diversifying it into other asset classes, other stocks, other options, et cetera, then you need the money today. You need to actually collect the cash. And in order to do that, you have to pay 30% taxes. It is what it is. The only way to mitigate that is maybe to move to like Texas or Vegas or Florida, and hopefully not have any crazy state taxes. But that's it. That is how I think of selling options. All right, questions. Are people confused or not? Amit, in terms of getting assigned for calls, when does that usually happen? We will talk about selling calls now. We're going to get into that in a second. Do we get this? Do we get selling puts? Do we get it? Does it make sense? Is anyone confused at all about selling puts? Is there literally anyone out of the 865 people that are here? Thank you everybody for being here on a Saturday afternoon. Is anyone still confused? My goal, it would make me the happiest if literally no one is still confused. You can still have some questions and stuff, but I want people to understand the very, very, very basics of this stuff. Because we talk about it on the show every day, right? Talk about it on the market open, talk about it on the market close, talk about it with TJ. There's so many times, and on Twitter, you're probably going to see me. I posted something on Twitter last night that talked about a strategy like this. So when you guys see this, I want to make sure everyone fully gets it, because then it's just easier to talk about it on the show, and then easier for people to potentially take action off some of the trades that other people are doing. Jason talks about this all the time on the Technical Tuesday, right? So if this community is going to get into this, then I want everyone to fully understand this stuff. JTB, thank you for the $10 super chat. Will buying puts tie up money for the period of the contract? So not buying puts, selling puts. This is a mistake I made a long time ago as well when I was just getting into the terminology. I kept saying buying. This is something you gotta try to get out of your system immediately. You're selling the puts. So selling the puts, yes, it ties up your money for the period of the contract. So if I sell 10 contracts on Robinhood at $45, that means 45 times 100 is 4,500. 4,500 times 10 is 45,000. That 45,000 is not in the vicinity of my ability to access for the next 28 days. That 45,000 is gone and it's stuck in collateral. Oops, I meant selling. Yes, a lot of you guys are going to make that mistake. I made that mistake for at least like 8 months, bro. I kept saying buying puts, it's selling puts. So once you say it the right way, you'll also internalize what it means. Now, having said that, this goes a little bit deeper, but there are some brokerages where you don't have to put up the full 45,000 in collateral. Like my uncle, he's on margin in IBKR. They're taking like 20 to 30% of the actual collateral he has to put up, which basically magnifies his buying power even more. We're not going to get into that. That's probably for another session. But for the people that are doing this for the first time, yes, you have to put up the collateral and it's stuck for the next 28 days. Now you can get it back if you close the contract early, but that means you're not keeping all the premium. But if you are actually holding the contract till expiration, yes, you have to hold those contracts. You have to hold those contracts till the end of the expiration, and the brokerage will hold your premium till your collateral till the end of expiration as well. We're not going to talk about margin. We're not going to talk about selling puts on margin. That is for another day. But for people that are just getting into this, the obligation is that you get premium if you put up collateral, and that collateral will stay inside of your brokerage for the extent of the contract. And that collateral will be auto-executed. For example, if Robinhood's at 44 and you have a strike at 45, Robinhood will immediately, on the day of expiration at 4 p.m., buy those 100 shares. And now you are down technically 50 cents if you got paid 165. So your break even is 43.50. You are down 50 cents on those shares if the stock is at 44 or 42, 43.50, whatever it is. So always, always, always think that the collateral that you're putting up is gone for the lifetime of the contract until you close the contract. And you could close the contract at a loss and get your collateral back, so you're happy you got your $4,500 back. But if you lost on the money the 165, right? You have to pay more than the premium that you got to even get the premium in the first place. AKA, you have to pay more than $165, which is less than what you got for putting up the collateral. Then it's not worth it. Which means, you have to ask yourself, why did you get into that contract in the first place? Cool. All right, let's get to covered calls. Abhijit, thank you for the $10 super chat. Appreciate everyone who sent a super chat. Hopefully you guys are enjoying this today. And now we're going to end off with calls. All right, cool. So selling calls. Okay, so what is the point of selling a call? The point of selling a call is, do I have my slide for this? No, my slide's being weird. Okay, I'm just going to say it off the top of my head. It's just like 2 sentences anyway. So we talked about buying a call, right? The point of buying a call is that you think the stock's going to go up. The point of selling a call is you think the stock's not going to go up as much as the buyer thinks it's going to go up. So let's use Robinhood again as an example. If I am selling a call on Robinhood, that means I'm selling it to someone who's buying it, right? So Robinhood's at 51. Let's say in 3 months, someone thinks that it's going to go to 60. Okay, let's say by March 21st, someone thinks it's going to 60. The only way they can buy that call, which is what is the definition of a call again, right? The definition of a call is the right to control 100 shares of the underlying stock. Why do people buy them? Because it's cheaper than buying 100 shares of the underlying stock. In order to buy a call, someone has to sell you the call because there's 100 shares in the middle that need to be controlled, right? So if I'm buying a call for the right to own 100 shares of Robinhood at $60, for example, someone has to be selling me those rights to those 100 shares, which means someone has to have the 100 shares. Let me say that again. Someone must possess in their brokerage, in their hedge fund, whoever is selling the call, the 100 shares to give the buyer the ability to buy the right to control those 100 shares. This is why you need, or this is why they call them covered calls. So we'll just write this up right here so that everyone can see it. So covered calls. Covered calls equal 100 shares of the underlying stock that is put up for sale at a certain strike price and expiration. So, example, you have 100 shares of NVIDIA at an average price, cost basis of $100. Okay. So you have an average of $100 on NVIDIA and you have 100 shares. So your cost basis was $10,000. You sell a call for, let's call it 150, expiring on, let's say 3/7/25. And in order to sell that call, you are obligated to put up the 100 shares in collateral. Now, what are the scenarios of how this ends up playing out? Well, here's the scenario. If NVIDIA is above 150, the strike, by 3/7/25, then you must sell your shares at 150. Not at 151, not at 160, not at 200. If NVIDIA gaps up to 200, you have to sell the shares at 250. If NVIDIA is below 150, which is again your strike, by 3/7/25, then you keep the premium that the call buyer paid and you get your 100 shares back from collateral. Just like on the Robinhood example, you get your $4,500 cash back if the stock goes in the right direction. Same thing here. You get your 100 shares back from collateral. But the reason it's called a covered call is because the 100 shares are covering the call. The 100 shares are covering the call. Begin Trade 71, thank you for the $50 super chat. Appreciate you. Thank you for being here, and thank you for the $50 super chat. So, why have I been messing with Steve about his covered calls? Why have I been like kind of poking him so many times? Well, Steve and Fiorillo, our beautiful, amazing, fantastic, exceptionally smart individual friend, decided that when Palantir was, I think, 30, 32, whatever it was, 8 months ago, that Palantir would not get to like $45 by January 2026, which was at that time the highest strike price that you could pick on the options chain. We talked about about 30 minutes ago that the strike prices go higher if the stock goes higher because then the market makers begin to develop a bigger market for the options. Well, Palantir is at almost $80 right now. And Steve said that Palantir would not, and that's Steve, I'm picking on Steve, but a lot of people in the Palantir community felt that the stock would not get above 40, 45 in a year because 35 is already an $85 billion market cap. 45 would be a $100 billion market cap. Is it really going to get to a $200 billion market cap by then? Well, yeah. Well, yeah. It's a $200 billion market. Basically, it's a $200 billion market cap right now. Our good friend Dougie Dollars also made the same trade. I don't pick on Doug as much as I pick on Steve, but yes, Doug made the same trade, right? So now what happens in this situation? Basically, you lost. GG. You lost, and you're going to have to pay the piper. What does that mean? So let's talk about the scenarios. We'll use Steve as an example here. Steve said Palantir, and this is also explains why Steve's so upset every time the stock is going up. But you'll like, I think now everyone will understand when we break this down why he's annoyed that the stock keeps going up. If you sell a call and you think the stock price is not going to get above that price, because again, then you're obligated to sell at that price. If Steve had to sell his shares at 45 and the stock's at 90, and I don't know how many shares Steve's has, but let's just say it's a decent amount of shares, he is missing out on $45 of price appreciation. 90 minus 45. 45 was the strike. 90 is where the stock is at right now, or 80, whatever it is. And that hurts. That hurts. Because if you've got 2,000 shares that are up for sale, 2,000 times 45, I mean, it's almost $100,000, 90,000 bucks that you're missing out on because you thought the stock wouldn't get above 45. So the seller of the call, the downside of selling calls, TJ got into this problem as well with Palantir. He had the exact same thing as Steve. He just ended up like taking the loss and moving on from the position. Steve is still stuck in it, but he had the same problem. He sold calls on Palantir when it was at freaking when it was at 17. I think he sold calls for 35 for 2026. Palantir's at 80, which means it's dead money for him to be waiting for the next year, because unless you think Palantir is getting back to 35, the buyer of that call is winning and the seller of that call is horribly losing. The buyer of that call said, hey, we think Palantir is going to get to 35 when it was at 17, and we think it'll happen by January 2026. It's only January 2025. Palantir is almost 2x above that strike price of 35. And if nothing happens in the next year, let's say Palantir doesn't go up, Palantir doesn't go down, it is still going to be substantially higher than the strike price that the seller determined, or the seller thought Palantir wouldn't get above. And as Matt Money says right here, that's why you have to be cautious about how far out you sell on your covered calls. So the reason Steve keeps getting pissed off when Palantir goes up, and the reason why I was telling him don't get cocky and just pay the price you have to pay when Palantir was at 65, because it already fell 20%, is that if Steve bought back those calls, if anyone is in a situation where you sell a call on a stock way out into the future, which means you have a lot of extrinsic value, a lot of time value on the contract, and the stock then quadruples or at least doubles, you have to pay money to buy back that contract, meaning you have to give back all the premium that you got from selling the call from the buyer, plus a lot more, because now you're down on the position and the stock has gone up so much that the value of those calls that you sold are substantially higher than when you sold them. And we'll look at an example in a second. So when Palantir fell to 65, I know a lot of people were getting out of some of their covered calls, even if they had to pay a net debit, meaning even if they had to pay thousands and thousands of dollars plus the premium to get out of it, at least they weren't paying hundreds of thousands of dollars, because Palantir fell 20%, which means the call premiums went down significantly. That's what happens when a stock drops, 20, 30%. And you can buy back some of those calls for a profit or for a small debit, maybe even a little bit more than a smaller debit, but at least you get to control your shares again. You get to control your shares once again. And so when you get to control your shares again, that's actually really nice, because now you can do whatever you want with those shares. You can hold on to them. You can sell calls against them again at a different price. You have the flexibility to do what you want to do with your shares, which is very, very important. So if you are down on the covered call, you have to give back all of the premium that you got plus the value of the contract, because the premium in and of itself is going to go up. So if you got paid $8 a share and the contract is now $20, you have to pay $2,000 over $800, which means you're losing $1,200. 800 plus 1,200 equals 2,000. So you're giving back all that premium that you got. That's going back, plus an additional amount of money to be able to get out of those contracts. And that sucks on selling covered calls. Now, the beautiful thing about selling covered calls is that most of the time, stocks don't do what a Palantir did. Stocks don't just go crazy, crazy, crazy up and to the right, and then everyone who sold the calls gets burned. Most of the time on, I guess I'm generalizing a little bit too much, but I guess this is not a generalization. Most stocks don't 4x in a year like Palantir did last year. Right? So I feel like that's a pretty objective thing you can say. So if most stocks aren't going to go up 4x in a year, or they're not going to pull an Nvidia that goes up 3x, or they're not going to pull a Tesla which goes up like 3x or 2x, 2.5x in the matter of 2 months, you can sell out of the money calls and you can collect the premium that the gamblers are paying you because they think that thing's going to go up. And you can use your shares as collateral to then get the shares to produce income for you. So let's look at some examples. Let's look at the NVIDIA call option chain. Okay. So NVIDIA is a stock that is highly liquid. There's millions of people buying and selling calls on NVIDIA. So this is a perfect stock to be able to do calls on, to sell calls on. So let's go out to March 7th. This is 41 days. This is 41 days out, and this is after the earnings. Okay, the stock price is at 142 right now. I can sell a call. Let's do a simple example first. I can sell a call at 145. I am getting paid $8 freaking $35. $8 Meaning, if I bought 100 shares today at 145, you're not assuming your cost basis, right? You're assuming that the percentage return is based off of buying those shares today. So if I buy 100 shares today, okay, and those 100 shares times 142 is going to cost me $14,200. $14,200. I can sell a contract at 145, meaning I think in 41 days, NVIDIA will not be above 145. That is the barometers of the contract. And the market will pay me $835, $8.35 times my 100 shares, aka one contract, which is my collateral, the 100 shares. That's how I'm covering the call. 835 divided by 14,200 is a 5.8% return, a 6% return in 41 days. Which is not bad. It's not bad at all. If you spend 14,000 today and you can get 6% on that 14,000 in 41 days, that is incredible. I mean, that is an absolutely fantastic return. But the obligation is that if NVIDIA goes to 170 and you have to sell your shares at 145, which is what you're contractually obligated for, 170 minus 145 is $25 times 100 because you have 100 shares. That's 2,500 that you are missing out on. Now, if we take it to the Steve example with Palantir, selling his shares at 45, Palantir's at 90, that's $45 that you're missing out on times tens of thousands of shares. That's a lot of money. That's a lot of money, right? So the beauty of selling calls is that if you are unemotional about NVIDIA, like you don't care about NVIDIA, you're like, look, I'm buying it at 142. I'm happy to sell it at 145. Quite frankly, I think NVIDIA is already a bit overvalued. I think NVIDIA's fair value is closer to 120. So I don't even think it's going to get to 145. If you're unemotional about it and you sell that call and you get paid $8 freaking 6% on your money to buy or to sell that call to some gambler who thinks it can get to 145, again, that gambler might be pretty sophisticated in thinking that NVIDIA to 145 by March is a really good bet. He's gambling, but it might just be more sophisticated gambling. Then that's the exchange of you selling the call versus that person buying the call, and someone's going to be right, someone's going to be wrong. Someone's going to be right, someone's going to be wrong. Now, let's get to a deeper example. Let's go away from 145. Let's go to 170, which I would say is a pretty substantial move on NVIDIA. 170, March 7th, 170 minus 140 is a 21% gain. So this would be a 21% gain in the stock in 41 days, which is, I don't think that easy to happen. But nonetheless, it's possible. Anything is possible. But I would say it's a little tough to believe NVIDIA is going to gap up to 170 in 41 days. Maybe 150, 155. Maybe their earnings are just so amazing they could potentially get to 170. But this is possible in the options market, and that's why there is an options chain around it. The market is praying $1.90, aka $190. That means there are still gamblers out there that think NVIDIA can get to $170 in 41 days. Let me say that again. There are people that are out there. It could be Nancy Pelosi, but she tends to do a little bit more. She's actually more sophisticated in the money, long leaps. So she's actually a bit more sophisticated. There are people out there that are saying, you know what? I'm kind of bored. I think NVIDIA can get to 170. I'm going to pay freaking $190 of premium, which the option seller might be thinking, you are literally burning your money, flushing it down the toilet, but I'm happy to take it from you if you want to do that. That's what the option seller is thinking. The option buyer is thinking, you're not bullish enough on NVIDIA. That is the difference between the option seller and the option buyer. Now, if you buy 100 shares of NVIDIA today at $142, that's $14,200. You're getting $190 to sell a $170 call. You are still making a 1.3% return on your money in 40 days. There's not a lot of places in the world where you can get 1.3% in 40 days. If we annualize that, that is 11.8%, which is still outperforming the S&P 500. Now, I know the past couple of years, the S&P 500 has done very well, but if we look at it from a historical perspective, that's still outperforming. But you might not even care about outperforming the S&P. You might just have, see, here's the thing. This is the example I did with TJ on SoFi on Friday. TJ has like 200,000 shares of SoFi. TJ has 150,000 of those shares up for sale at $20. SoFi is at $18. And this is the one issue I've always had with TJ when it comes to selling covered calls. Sometimes, and we've had debates about this on the show, which I think are very healthy debates, I think he's a little too aggressive with selling his calls. I think TJ, especially when a stock is getting up and re-rating in narrative and it's changing and the market's finally getting the stock, he gets a bit too aggressive on selling the call at a certain price. Now, granted, TJ's working with a lot of money. He has certain obligations he has to meet. He wants to get 3 to 4% a month. So he doesn't really care a lot of times if the stock gets above his strike price. He just wants to be able to generate the premium. There are some people that sell options in a different way. That's his philosophy. So on Friday, I was like, TJ, what if we sell the other 50,000 at $25? Because as bullish as I am on SoFi, I mean, $25 after earnings would be a hell of a move. And I wouldn't be upset to sell my shares at $25 because I think that's a pretty dramatic move. And, you know, if that does happen, you should be happy with selling the shares at those levels. But in all reality, that's probably not going to happen. Who knows? Maybe Noto surprises us on Monday. We'll see. But that probably won't happen. So TJ agreed. And I think the reason he agreed is because he also is kind of feeling a little anxious that maybe SoFi really does like change the narrative. Usually SoFi pumps and dumps. Maybe SoFi actually fucking crushes it and SoFi legit becomes a $20 stock, $23 stock, and we never see the low teens again on SoFi. We picked up, I think, $3,500 in premiums off of, how much was the collateral? It had to be like 500,000 in collateral, something like that, $600,000, a lot of collateral, right? So that is 3,000 divided by 500,000. That is 0.6% on our money. That's less than 1% on our money. Is that a good return? Not really. But if he didn't want to sell those shares anyway, $3,000 is $3,000. And this is the other part of selling calls that is very important to me. If you don't want to sell your shares, let's say you got Palantir shares right now, and you think that it's not going to go to 120 in 2 months. We just looked at the options chain. Someone is paying $120, $123, $1.23 for a call option that Palantir will get to $120 in 2 months. Do I think it's getting there in 2 months? No. I think Palantir is going to have to show substantial growth to get there. Could it get to 85, 90? I think that's reasonable. But to $125, I just think that's a lot for Palantir in the next 2 months. But still, there are people that are out there that are willing to pay you $1.23 per contract because they think it can get there. Okay, so if they think it can get there, and I'm sitting on 10,000 Palantir shares, and I do 10,000 divided by 100, which means I can sell 100 contracts times $123 because that's what they're paying per contract, I can still make $12,000 in 2 months, which one could argue is free money if you really think Palantir is not getting to $120 by March 21st. Now, maybe it does. And I'm sure Steve thought it was free money when he was selling calls at Palantir at 45 because he was like, there's no way this thing is getting to 45. Now it's at 80. It wasn't free money. It was very expensive money. But now that Palantir is already 4x'd and there's still people willing to buy call options at $125 of a strike price, and they're willing to pay $1.23 per share to get there. If you've got 10,000 shares and you put them up for sale at 120, two things. A, are you going to be Upset if you sell at 120? Realistically, if you bought them at $20, $30, $40, even if you bought them at $50, probably not. You're not going to be that upset. Like, in all seriousness, would you be upset for a day? Yeah, but then you would look at like $1 million and you'd be like, okay, it was time to sell, right? B, do you think it's actually going to get to 120? And I think most Palantir bulls would say, look, that's assuming almost a $300 billion market cap. No, it's probably like the growth is probably not there yet to get there. So then why are all these gamblers out there willing to pay $1.23 on the idea that Palantir gets to 120? Because they're gamblers. Because Vegas is Vegas for a reason, right? Why was I willing to pay money for Robinhood to get to $25 when it was at $8? Because I was a gambler. I just happened to be right. And I happened to be in a good situation where Robinhood was ready to go up. But now that Robinhood's at 50, I mean, look, I'm not buying a call option that it's going to 70 next week because it's already up from $8 a year ago. And so the beauty of covered calls, and let's talk about Matt Money now, right? Matt Money on the market open on Thursday. I think he has like 20,000 shares of Rocket Lab. He probably has more than that, but let's just use 20,000 as an example. He's putting them up for sale at $36. Rocket Lab this week went up 35%. Why? I have no idea, but it went up 35%. So I think he sold them for next week, February 7th, $36. The market is paying now 43 cents. I think he got them when they were paying like 35 cents. So let's do the math right here. Matt Money has 20,000 shares of Rocket Lab. Let's divide that by 100 shares of contract. He can sell 200 contracts. Someone was paying when he sold those shares 35 cents for Rocket Lab going to 36, which is $35 a contract, 35 cents times 100 shares. 200 times 35 is $7,000 freaking dollars of basically free money if you think Rocket Lab will not be above 36. Now, look, maybe Matt Money is going to be caught in a little bit of a pickle there. Maybe Rocket Lab is going to go above 36 and maybe maybe those gamblers are going to be right and Matt Money wasn't bullish enough. But he understands the company pretty well. He's been following the company more than anyone that I know. He's probably looking at the valuation and he's probably happy that it's up a lot, but he's also probably being conservative enough to say, you know what? It's probably going to take a breather because it can't just keep going up like that because there's not really any big catalyst. There's no earnings, nothing like that. And so if he's right about that, and we'll find out by February 7th if Rocket Lab's at 36 or not, he has just collected $7,000 from gamblers that were willing to pay for the anomaly that Rocket Lab continues to go up from the 32% year to date that Rocket Lab is already up. Do you guys get why this is valuable now? Like this is why selling calls is such an incredible strategy. Because if you think the stock is not going to get to a level that someone else thinks it's going to get to, and you know the stock better than that other person, or quite frankly, you don't even care if the stock gets there because you're fine with those shares being called away, which is what we call it when your shares get sold. Someone bought a call, you sold a call, your shares get called away if you lose on the direction of the trade. If you don't care about the shares getting called away because you're happy with the premium plus the price appreciation that you got, as On Beneficial says, or you just are knowing that you're right, that there's no way in hell Rocket Lab's going to be 36 by February 7th, and you keep your shares as collateral, and then you keep the premium, and then you get to rinse and repeat because there's plenty of more gamblers willing to buy these calls that are so out of the money that you're willing to sell them. You can turn this into a legit business, especially if you're heavily concentrated like Matt is on Rocket Lab and you've got 20,000 shares producing you $7,000 a month. I mean, that is like replacing a corporate salary. That's like real money, dude. That's like real transformational money. Obviously, now 20,000 shares, he bought it at like $5, right? So he needed that $100,000 to even, be able to do this. You need the money to get started. This is why option selling, it is a capital intensive business, and there's no way to get around that. You do need the money to get into this business. But once you have at least 6 figures to get started with, it can produce incredible returns. Share count is a big piece of it. Picking the right stock is a big piece of it. You can't do this on Grab. Grab does not have that many gamblers. Grab does not, people don't really think Grab's going to get to $7 by March. There's not a ton of gamblers that are in Grab. Therefore, you don't have an options market to sell to those gamblers. But on Rocket Lab, on Palantir, on SoFi, on Robinhood, on NVIDIA, on Amazon, Google, Tesla, The micro strategy, the gamblers are, I mean, it's Vegas every day for them. And that is why Michael Saylor, you hear him talk about selling volatility. The reason he says the options market is so juicy is because he knows that there's buyers of the volatility, but there's also sellers of the volatility. When he says you're selling vol, he means you're selling volatility. You're selling calls against the volatile nature of the underlying asset, and you're able to collect premium against that. And the buyers are able to give that premium because they believe in the MicroStrategy thesis, and they like the volatility. As Michael Saylor says, the volatility is vitality, because when you have something that is volatile, you have something that gives it life. If you have something that's not volatile, there's no life in it. There's no options market. There's no juicy premiums. There's no sellers. There's no buyers. And at that point, it's probably just better to buy the stock and hope that the stock continues to go up in value. There you go. That is selling calls. That is selling calls. Again, here is the example for those that want to see the example that we used. But that is the benefit of selling calls. That's why I like selling calls. That's why I like selling puts. And that's why I think philosophically, selling options is not a horrible strategy. There are ways it can go wrong. We talked a lot about those ways. There are ways it can go really right. And we talked a lot about those ways. There are ways buying calls can go really right. There are ways buying calls can go really wrong. Same thing with puts. The difference between buying and selling options is when you buy an option and it goes wrong, you lose all your money. When you sell an option and it goes wrong, the worst thing that happens is you have to buy the shares at a certain price if you're assigned on a cash secured put, or you have to sell your shares on a covered call. And think about that as an answer. Like, is that the worst thing in the world to sell your shares at a higher price than you bought them at? No. Like, that's not a losing scenario at all. I don't care if the stock triples from where you sold it at. You made money. And in a market where it's very hard to make money, if you're able to make money, even if your stock is sold at 170 and the stock ends up going to 300, you still made a profit, and no one went broke making a profit. You might have a little bit of regrets. You might not feel the best that you could have held on till it got to 300, but that doesn't matter, because if you knew it was going to 300, you would have never sold the call in the first place. The whole point of selling the call was to capture the premium on the volatility in the short term. And as a result, if you were wrong and the stock went up, at least being wrong didn't mean that you lost money. You lost opportunity cost on more money, but that's not the same as losing money. Losing money on the buyer side hurts a lot more, in my opinion, than on the seller side. Because on the seller side, at least you own the shares on the puts, or at least you get to keep the cash from selling the shares on the calls, but you don't actually lose the money. And there you go. That's it. That is it. That's what I've got today. Kevin says, I almost love you as much as I love my wife. Well, hopefully these strategies are useful enough for you to make some money and then buy some good gifts for your wife. Good, you may take her out on a good dinner, get her a nice Chanel bag. I mean, and realistically, I'm saying this because, TJ talks about this all the time, dude. He's been able to really change his lifestyle because of selling options. I know a lot of people, dude, like I paid off $4,000 of my mom's revolving credit card debt. I didn't even freaking know she had revolving credit card debt. I just asked her in December. I was like, Mom, do you have credit card debt? She was like, yeah, I have like $4,000. I'm like you're paying 25% a year on that $4,000? She's like, I'm like, all right, like we're getting rid of this. Like now, like right now, it's done. Like, no, we are not going to be paying interest on revolving credit card debt. Why is that? Because of options. Because of options. In my scenario, it was because I bought options and I was able to make some money. But, I'm not going to go into this example because it's way too complicated for this session today. But yesterday, I locked in a $15,000 profit in 3 weeks, which was 11% on my money from selling options. And that's for at least for me at this point of life, that's pretty good money. $15,000 in a month. That's actual money, not paper money in the stock market. Like the stock goes up and you see that you're up 15,000. This is a legit 15,000 that I have in my brokerage because of selling options that I was able to capture in about 3 weeks. This is the benefit of learning how to sell and sell puts and calls, and then strategically buy puts and calls when it's the right moment. My philosophy is just buying puts and calls. You've got to be really right, and you've got to be really lucky to an extent. For selling calls and puts, you do not have to be lucky, and you don't have to be right, because the downside is not losing money. It's maybe bag holding some shares, which if it's a good company, that's not a bad thing. Or it's selling shares where if it's a good company and you made a lot of money on the run up to your strike price, that is also a great thing. And so, whether it comes to treating the wife on a good dinner or paying off some of your credit card debt, the way to do that is in two ways. And the number one way, and this is the number one way that I think everyone would appreciate, your income has to go up, right? You have to make more money at the end of the day. You have to make more income in order for this to play out. But the other way for this to play out is for you to get some income from the stock market by utilizing the shares that you already have or the cash that you already have to generate some premium. And that premium then turns into income. That income turns into the ability to do what you want with the rest of your life. And that's it. That is it. June says, if selling covered calls and stocks hit strike price, why not just collect premium and repurchase shares? Yeah, you can do that as well. Then again, June, you would have to buy. So if you sold your shares at NVIDIA, if that was your strike price, now when you buy your 100 shares of NVIDIA, you have to buy it at 170, not at 140, right? So if you buy your 100 shares at 140, sold a call for 170, and then NVIDIA, let's say, goes to 180, you can sell the shares and you can collect the premium and collect the upside from 140 to 170. But now you have to buy your 100 shares again at 180 if you want to sell the call again. So you can, of course, do that. It's just you're going to have to pay more money to get back into the game of selling calls because your 100 shares would have got called away. Amit, I have a question. I had an option expire in the money. What does that mean? It depends on what the option is, right? Whether it's selling a put or selling a call. So if you sell a put and it expires in the money, you then are obligated to then buy those shares. If you sell a call and it expires in the money, then you potentially don't have the obligation to sell those shares. So it depends on the put or the call side, but ultimately it's which way that you put it into, up or down on the direction of where you sold the put or where you sold the call, or where you bought the put and bought the call. Because if you buy a call, for example, when I bought calls on Robinhood, they were out of the money. It was $8. I bought them for a $25 strike. Robinhood got to $40 by the time I sold them. They were deeply in the money, which was good. Sometimes that's bad if you're selling the call, right? Because then you have to pay the piper. You have to get the obligation for the shares, or you have to pay back the market to be able to get your shares out of control from the covered calls. But if you're buying the calls, then it potentially is a benefit for you because then you get deep in the money. And that's how you do it. I see Chris in the chat. I fundamentally disagree with Chris. I think Chris is dead wrong on this. I think Chris is a good mentor. I think it makes a lot of sense. Chris got a lot of comments on his Twitter post that he tried to be smart about yesterday, and he hasn't responded to any of those comments, Chris. And I think you haven't responded because you don't really have an answer. I disagree with Chris on this. I love Chris. He's a great mentor. I've made a lot of money using Chris's strategies. I think Chris is dead wrong on how he thinks of the philosophy on option selling. And that's okay. That's okay. And Chris, I would love for you to respond to some of those people. If you were going to quote my post yesterday and then try to get one up on me, there's a lot of people that responded to you that were calling you out. You didn't give a response. You didn't give a response, buddy. And we need some responses because from my understanding, you haven't checked your notifications today. I'm just messing with Chris right now. Me and Chris, we love each other, right? We mess back and forth with each other, but there's no response because I don't think he has a good response. And I think my interpretation of Chris's philosophy, and we've had a debate live on the stream, is I think he is dogmatic and ideological about how he thinks about this stuff. I think he has his strategy and it's his way or the highway. That's fine. But for the majority of people, buying leap spreads on a stock that you think is going to go up by 300% in 2 years is not a reliable strategy at all, especially if you're not in Chris's Patreon. Because then what fucking stock do you buy the call options on? Like, how do you figure out the stock? But if you're relatively bullish on an NVIDIA, on a Palantir, on an Amazon, stocks that are not controversial, not the cruise lines, which you have to do massive amounts of due diligence to find out their depth structure, which most people that have 9-to-5s are not doing that shit, but they know Amazon's not going anywhere in 10 years. They can sell puts. They can sell calls on Amazon. They can collect premium. They're not going to make 3,000% like Chris, but if they make 3% in a month, that is okay. That is okay. And that's the difference. Chris's strategy is about buying calls on a stock that is undervalued and riding it up high. A, you've got to know the stock. B, you better be damn right about it. Because if you're wrong, which Chris has been wrong before in the past, we call out Chris's wins. He has some losses. Snowflake, that one didn't work out. Snowflake stayed flat. That one didn't work out. You lost all that money. Now he has other ones that have worked out. Cruise Lines, Verizon's, TFC. And Chris has many, many, many wins, right? But everyone has some losses. And in the difference here is if you sold puts on Snowflake, you would be bag holding shares. But Snowflake was up 30% at the end of the month in December. You recovered 30% of what you were losing. If you bought those calls on Snowflake, those calls are gone. Those calls are gone. Or that premium that you paid for those calls are gone. That is the difference that I think. Chris, I'm not sending you a StreamYard because it's been 3 hours and I've got to go. I've got a lot of shit to do. I love you, brother. We will do this again. We can do this next week. We can have a full debate. But I've been literally talking for 3 hours straight and I need to go. And I have to go. So I'm out. That's it for me. Me and Chris will absolutely have a debate. But we've had this debate already, which is why I don't really want to have this debate right now after 3 hours of me talking. Because we just have a difference of opinion. And if we have a difference of opinion, it is what it is. My point is that on one strategy, you are taking a risk on if the stock goes up and you hope to God it goes up. If not, you lose your money. On the other side, either the call goes up and you sell at a premature phase, but you still make money, or you buy shares and you bag hold them. And if it's on a good company, you get to hold them forever. And if Chris doesn't understand that, then we're just always going to have a difference of opinion. And that's okay. That's okay. I'm just messing with Chris right here because he called me out on Twitter, but he's not responding to any of the comments. And I'm like, okay, you can't just you can't just call someone out on Twitter. And then when everyone, some really sophisticated accounts say, wait a second, Chris, what the hell are you talking about? What are you saying right here? And then you don't respond. Come on now, buddy. You can't dish it out if you're not willing to take it, my brother. And I love you, but you got to be able to respond to that stuff. So that is my difference of opinion. That is my difference of opinion. All right, guys, we will do this again next time. Chris and I will probably have this debate again eventually, but if we don't have this debate, it's just a difference of opinion. I'm sure there's some people here that deeply agree with Chris, some people that deeply agree with me. That's okay. This strategy was, this session, this 3 hours was to give an explanation on what is an option, what's the point of buying options, what's the point of selling options, and then how to think of options strategically in the stock market. And if you are brand new to the stock market, hopefully puts and calls are much more clearer. Buying calls, buying puts are much more clearer, and selling calls and selling puts are much more clear. That's it. That's it today. Mila, thank you for the $20 super chat. I appreciate it. Thank you for everyone giving me super chats today. Really appreciate it. My t-shirt is inside out. I like 3 people text me like, dude, your t-shirt's inside out. I'm like, all right, well, I'm not going to change my shirt right now. So yes, my t-shirt's inside out. It is what it is. That's how we're doing this. But hopefully this was good for people. Brown on brown violence. Dude, literally, it was brown on brown violence last night with Chris on Twitter. It was 2 browns going against each other. But there it is. All right, can we get some W's in the chat? Did we like this? W's in the chat. Was this good? Was this helpful? Was this 3 hours something you can go back to visit over the coming months? I hopefully think this was very, very helpful. Hopefully it was strong. Hopefully everyone got value out of it. I have not eaten anything today or drank coffee. So I don't know, dude, when it comes to like just stock market stuff, like I get excited to talk. And so this is just 3 hours off the top, no coffee, no energy, but I'm excited to do it. It's fun to do it. And quite frankly, I've cleared it up better in my head because if you can explain something and teach something to people, then you should be better at executing those strategies. So there we go. We got that done. When are we going to do options 201? Probably not next week because next week is busy, but it will happen most likely later in February. But we'll definitely do a 201, 301. And then we'll have Chris actually come on the show and talk about call debit spreads because that's probably like option 301. And we'll have Chris probably explain why he likes that strategy so much more than selling options as well. All right, good stuff. Love you, everybody. Hopefully you guys enjoyed it. I'll see you guys on the future show tomorrow for Sunday. Bye, everyone. Have a good one. See you guys tomorrow night. Bye, everybody.